Good morning, everyone, and welcome to this presentation with SmartCraft. My name is Øystein Lodgaard. I'm the analyst that covers SmartCraft here at ABG. And with me today, I have Gustav Line, who is the CEO of the company. So with that, Gustav Line, the floor is yours.
Thank you very much, Øystein. And good morning to everyone. Let me take you through SmartCraft. I'll give you a brief presentation. So maybe please switch to slide number 3. So SmartCraft is a company that delivers software for construction companies. And as you can see, construction companies, they are in an industry which is one of the largest industries in the world, but also one of the least digitalized. So digitalization in this sector will happen, and we are a company that's well positioned to be part of this growth in the future. Our focus is small to medium enterprises, and today we are represented in the Nordics, in Norway, Sweden, and Finland. We have about 200 people located in several locations in that area. We have quite a lot of customers and went on the stock exchange June 2021. Please go to the next slide. So what is the challenge for companies in the construction business? Well, basically SME companies, if they don't have a good digital system to solve mission critical tasks, everything they do will have to be done manually, calling to order parts. They need to fill in different checklists manually and so on. So basically, we help these companies with three things that are mission critical. One, to be in control of your people, to make sure that you have the right people doing the right jobs and that they invoice what they're supposed to invoice the customer. Number two, we focus on our solutions, make sure that you are in control of material, which is very important because this represents about 40% of the cost of the projects. And as you know, inflation has been very high lately. So our customers need to make sure they buy materials at the right price and also that they can invoice the right price to their customers. And then thirdly, documentation. The required documentation on building projects has increased enormously over the last years. And it's very important that our customers can fill in the documentation in the right way. These three things, people, material, and documentation, flowing together in one good flow is what we help our customers with. So please go to the next slide. We see a 10 billion market in the Nordics, and this market is growing double digits every year. The thing is that for mission critical solutions, like I just mentioned, people, material, and documentation, only 1/10 of that market is penetrated. So, which means that there's a large opportunity going forward. And there are also some very nice trends that are in our favor. First of all, these companies lack skilled workers and have done for several years. And also there's a long tail of projects and a long tail of maintenance and service needs for new and existing buildings. This is good news for our customers because they work with service, maintenance, and upgrades mainly, which means that there's work to be done for many years. And also, like I mentioned, that increased demand for digital documentation or documentation in general. This comes from both the regulatory offices that require sort of health and safety documentation, that you look after your people in a proper way, that nobody dies when they're out on the building site, but also that the job is done properly. And this is also filtering down to consumers because consumers want to have more digital documentation about the job that has been done, that they can pass this on when they sell the house. And of course, there are also young people entering this industry, and everything they do is done on a mobile phone, and they also expect to be able to do things using a mobile phone. So I think there's no way this industry is not going to digitalize. It's just a matter of how fast it's going to digitalize. Please, next slide. So if you just take you through very briefly how we help our customers. So if you look at the blue line, that represents the people in the office. They would typically be able to use a web client to send out a quotation, and when the customer accepts, they'll send an order confirmation. Based on that, they will do resource planning, who's going to do the job. They will start to buy materials from different vendors, compare prices digitally. Then they will get automatic invoices in. They will be able to see that the project is balancing or that they make the right profit. They will be able to see from the field workers any changes to the project and so on. And in the end, when everything has been collected around the project, they can send information to the accounting systems and also to the payroll systems. Out in the field, that's represented by the stapled line. At the same time, the field workers and about 9 out of 10 people work out in the field. So the field workers can sort of find out where they're going to work. They can find out what they're going to do. Then they can register the number of hours. And also, very importantly, they can do the self-checks as they do the job. Put on the right boots if they are an electrician to make sure they're not electrocuted, to use the right gloves, to remember to turn off the switch. This is something you do as you do the job, not a day after. That could be really dangerous. Similarly, before you close the wall, you make sure that you take pictures, that you fill in the right checklists, and so on. Then change management, very important. Very often the customer's customer would like to do some changes to a project. And of course, capturing that change out in the field makes sure that a company can actually invoice and get acceptance from the customer as they agree the change. It's very difficult to come up with a bill 3 months later saying this is due to the changes that you asked me to do when I was out working. So these are just some examples of how we help our customers. So please move on to the next slide. SmartCraft, we are it's very important for us to have profitable growth. And as you can see, we have been very consistent delivering a strong organic growth over the last decade. And we will, of course, continue to have that focus going forward. So next, please. So here are some metrics for SmartCraft, and I think there's some things I would like to talk about. In my opinion, I think we want to be a true SaaS company. And a true SaaS company, in my opinion, has a few important traits. One, it has a good organic growth. Of course, the customers want to buy the solution. It's an attractive and good solution. And we can see that SmartCraft has 16% organic growth. Secondly, I think a true SaaS company should aim to be easy to use. It should be very sort of transparent pricing. Customers should easily onboard a solution and so on. SmartCraft has a very high recurring revenue, which I think is a very important trait for a good SaaS company. We have 97% recurring revenue, which is among business-to-business solutions, among the highest in Europe. And that means that we are not having a big consulting department giving the customer a lot of pain or a lot of high bills, because a big consulting department means that you do not make good software. That's why you have a consulting department. We have very little consulting. That's more like expert services. And as you can see, a third factor that I think is very important is a strong EBITDA margin. We have 39% EBITDA, which I think proves that, again, we drive the company profitably. And I think that's super important in order to create discipline in SmartCraft to make great solutions that people want to buy and that we can make money. And I think fourthly, low churn. We have a 5% churn, which again is very high. It's down from 6% that we had a year ago. That's also a mentality in SmartCraft that customers should utilize to the full extent our solutions, and we should really make sure that they are really happy when they buy the solution. So organic growth, recurring revenue, adjusted EBITDA, and churn, very important factors. As you can see, we also grown quite rapidly over the last years with 9 acquisitions. All of those have grown both revenue and EBITDA after we acquired them. So that's interesting. We also have a 55% sales conversion, which means that every time we meet with a customer or when we meet a customer, we turn 55% of those meetings into sales. That's within a calendar year. So we don't lose 45. It's just that within a year we win 55 and then we win some of them the next year. The next slide, please. As you can see, we have a very strong and high quality shareholder base, mostly outside Scandinavia, actually. So that's something to think about for the Scandinavian investors, that you are not present, but a lot of very high quality investors are. And as I mentioned, we do have a solid track record when it comes to M&A, which is part of our strategy. And we also today have no debt and very strong balance sheets, and we create cash every quarter. So next slide, please. We see a lot of good potential to grow. We today have a very sort of nice price point for our customers. It's only 7 kronor per user per day. So we see an opportunity to grow the prices and upsell in the future, but we have not taken that. We want to win customers, and then we can always increase prices at a later stage as we bring more value to the customers. So our main focus is new sales. That's always important when you run a company, to win new customers, and also to upsell and cross-sell on the different customer bases we have. And we also think there's an opportunity to extend our value chain, for example, to our customer's customer. So that's also something we're looking at. And we also see opportunities to take the solutions we have into new geographies that we are already present in, taking a solution from Norway into Sweden or Sweden into Finland and so on. So that's something we're working with, but that's going to take a bit of time, and that's all ahead of us as good opportunities. Yeah, I think, just also at the same time as we want to grow our revenue, we want to continue to look into the churn reducing activities, which means keeping a high recurring revenue, but also being very careful that our customers can easily onboard, use the full extent of the solution, give them a lot of automatic training and so on. So guiding, training and so on is very important, and it should be free of charge so that they can have the benefit of our solutions. Next slide, please. We have a strategy to acquire companies. So far, we have acquired some companies to gain customer base, and we've acquired some other companies because they have some great functionality that we can add on to the existing customer base. And we will continue to do that, both in existing regions, but we're also looking to buy companies outside Scandinavia. And we are in dialogue with quite a lot of companies to see if we can find a good fit. For us, it's super important that we find companies that have some uniqueness to them, that they are not too generic. They need to focus on construction. That's very important. And also that they can show that they are starting to be profitable, or that they are growing nicely. So we see that they are commercially have a proof of concept. And also very importantly, that they have a SaaS understanding and mindset, because they need to join the SmartCraft family and really want to help our customers to have the best solutions in the cloud and available on apps. We have, again, money in the bank, no debt, so we have great opportunities, but we will only buy the right companies that we feel are part of our strategy. So we'll have capital discipline. Going into new markets, we will want to buy the customer base and buy the cultural and understanding rather than building this organically, as that takes a lot more time. Yeah, next, please. So to sort of to see on our guiding, we guide on 15 to 20% organic growth, and then the acquisitions that we might buy will come on top of that. And then we expect our margins to increase as we scale the business due to the synergies and how we sort of run the business more efficiently going forward. So next slide, please. Yeah, so I think to sort of round it off, we are in a market that is gonna digitalize. There's a massive opportunity. Loads of companies have still not got good solutions or solutions at all for the mission critical tasks, people, material, and documentation. We have a very strong position. We have excellent solutions. We are a leader in the Nordics. As I told you, we are a true SaaS player. We really drive to be a great company that will grow in the future through sort of the great dynamics that I talked to you about, growth and recurring revenue and low churn and so on. So I think these are some of the important reasons why SmartCraft is going to be a good company going forward. So, but make sure to follow us. You'll find more information if you follow us on the different digital areas. So with that, move to the last slide, please, and I think that opens up for the Q&A.
Yes, thank you very much for an interesting presentation, Gustav. I just wanted to follow up. You said that there's also a possibility for you to move some of your existing solutions into new markets. Would that require any significant investments?
Hi, Øystein. Øystein?
Yeah. Yes.
I think I was cut briefly, so sorry about that. I lost you in a second. So please repeat the question.
If you were to enter into new markets, would that require any significant investments?
Well, our strategy is not to go organically into new markets. We think that's quite difficult because we don't really understand the culture. We don't understand how to do the business. So we would like to buy our way into new markets, preferably by a great company, and then build some trust and understanding together, and then we can take our existing solutions that are good for that market into that market. So yes, we would like to buy the company, but no other investments in general than the acquisition costs.
And if you were to also expand your existing solutions into new markets, say other countries in the Nordics, would that require any big investments or?
Well, that's what we are sort of have started doing, basically using the teams we already have in the different markets. So our strategy is to, instead of having people go out and say, well, I only have this solution to sell, we can go out and say, you know, hello, Mr. Electrician, we have 3 excellent solutions. Let me talk about them and present those to you. So we don't have to come out and present one solution. We can actually present a portfolio of what we can do to these customers. So I think there are opportunities to synergize in sales. So we don't expect cost to increase due to this scale.
Interesting. And in terms of M&A, you of course have a very strong balance sheet, you have good cash flow, but you haven't done any big acquisitions or in the last 12 months. Could you say something about the reason behind that?
Yeah, like I mentioned, we don't do acquisitions because we have to or because we think we need to in order to increase our growth. We buy companies because they are right. And it's true, like you said, some of the acquisitions we've done lately have been great targeted acquisitions because they've got some great technology that we really, really like. But it's also important to remember, Øystein, that most of the companies in this space, construction companies, are quite small. So they are pretty sort of, up to 5 million euros. That would be the revenue typically. So they are normally not that big anyway. So I think we'll do some. I'm pretty sure we'll do more acquisitions. I'm pretty sure some of them will be bigger than the latest one we bought.
And I guess there have also been quite high price expectations from sellers in the private market. Have those started to come down now so that you may see potential to do more M&A going forward?
I think they have started to come down. I think the few things have happened. First of all, a year ago or up till maybe the summer, we saw quite a lot of noise in the market by big private equity companies wanting to get into this space and then really rising the expectations. They have all disappeared, which is good. So we don't have this noise when we want to go out and have serious discussions with potential targets. But they did raise the expectations and they have not come down to a decent level, which is also one of the reasons why we haven't sort of opened our wallets to buy at too high a cost. I mean, we can sit and wait and see what happens. So I think it's still a bit too expensive, Øystein.
Yeah, that's good that you are quite disciplined in the price you're willing to pay for acquisition targets. That's just good. And I also thought inflation is a big theme these days. Can you say something about how inflation impacts SmartCraft? Have you seen any big impact from inflation, and what do you think going forward?
We've seen some. Of course, there's a bit of inflationary pressure on some people cost and so on. We've seen some inflation on the cost of goods sold, especially on the hosting cost from the big American vendors and so on. They want to pass some of the exchange rate onto us. So we've seen some of that. But also on the other hand, we have not passed any of that cost on to our customers in 2022 at all. I know a lot of software companies have taken the opportunity to say, "Wow, now I'm going to charge you 20% more because we have inflation in the market." We changed the prices about 3 to 5% in the beginning of the year, and we haven't changed them since. Going into 2023, we will change them more than 3 to 5%, more like 6 to 9 to catch up with some of that inflation. But that should also cover the increased cost that we have. And the reason why we're doing this, Øystein, is not because we can't, because we could. We have very low churn. So for us to increase the price by 20% would be no problem at all. We will, of course, get some very angry customers. And that's why we're not doing it, because we have a trust relationship with our customers. We want them to refer us to other customers, because this is an industry where people talk and they refer vendors like us to other customers. So we don't want to abuse that trust relationship.
That makes sense. And lastly, we see there's a more uncertain macro environment right now. If your customers were to see lower demand, there'd be less activity from your customers, how would that impact you, if any?
Yeah, I think what we are mainly concerned about is, and this is also what when we speak to our customers, is that the new building sort of activities could go down. I think that's what most people are concerned about. But on the other hand, there are some, but we are mostly in sort of the service area. Our customers in the SME sector are mainly in service, maintenance, and upgrade, and that sort of happens anyway. I mean, most of that is going to happen anyway. If a pipe bursts or people need to fix something, as an example, if you look at the electro industry and electricians, we have loads of electricians as customers. That's one of the biggest customer bases we have, and remember that. Halogen lamps will be forbidden from 2023. So basically, you can't buy bulbs anymore, which means that you can't, all the systems, all the lamps and so on that has been installed with halogen needs to be changed. And this is very true for myself, because the lighting in my living room is based on halogen and is now not working. And I need to fix it, and it's quite expensive. So these are some of the positive drivers that is good for the industry, for all the electricians. So they're going to have plenty to do for a long time to come in with all the spots and everything that needs to be changed. So I think there are some positive factors, but of course in the newspapers we only read about the negative stuff. And again, the macro trends that I talked about, that still there's loads to do. Our customers have plenty to do. And the documentation needs is just increasing, and there's loads of customers, potential customers for us, that need to digitalize in order to be in business. So even both in good and bad days, our customers need SmartCraft and digital solutions to be on top of the game.
Thank you very much, Gustav, for presenting to us here today, and thank you to everyone listening.
Thank you.
Good morning, everyone, and welcome to this presentation with eWork, and a particularly warm welcome to Karin Scheel, who is the CEO, and Claes Reveil, who is the CFO of the company. Myself, my name is Simon Granat, and I'm the analyst at ABG that covers eWork. And for the coming 15 to 20 minutes, they will go through the company presentation, and then we will follow up with a smaller Q&A session. So with that said, the floor is yours.
Thank you. Thank you so much, and thank you for the invitation to present here today. We are happy to tell you a bit about our company, eWork Group, the market, and why we believe that we are well positioned for the future. And after that, you will hear about trends and results from Claes. So, with that, eWork Group, we are a company that forms successful collaborations by bridging client needs in one end with independent professionals in the other end. And these are professionals with the right skills that tie into the needs of clients, our clients. And simply put, we connect great ideas with our clients, with brilliant minds, with professionals and our partners. And in this way, we contribute to accelerating growth and development for businesses, but also contribute to the personal development of professionals around the world. So in terms of numbers, we currently have above 13,000 professionals on assignment across 50 countries, where 19 outside of Europe. We are based with own operations in 5 countries, in Sweden, Finland, Norway, Denmark and Poland. We source and acquire talent across Europe and outside of Europe. And we'll get back to more about that because that's an important trend. The turnover for the last rolling 12 months amounts to 15.243 billion SEK, and our EBIT amounts to 170.6 million SEK. And this corresponds to a 7.48 earnings per share. So in our own operation, we have currently around 370 employees across the 5 locations. We are headquartered in Stockholm, and we are listed on the Stockholm Exchange since 2008. So these are some short facts about our company. On our business model, as said, we bridge clients and partners and professionals, and thereby we tie into 2 important mega trends in society. In one end, the future of business and society, which is driven mainly by digitalization, green transformation, and all the needs related to that in terms of skills and talent. On the other hand, we tap into the future of work trends, where we see more and more people interested and willing to work independently, to choose when to work, where to work, and who to work for. And this is a clear trend. We see 2 important drivers here with professionals: remote work opportunities, and also the opportunity to work on a global basis to optimize the hourly rates for themselves. And again, our role is to bridge the needs of our clients with the opportunity to find the right talent in the market. And of course, the more we know about our clients' businesses, the closer we work to them, the better we can also support their businesses. And on the other hand, the closer we work to our professionals, the more we understand about their personal drivers and interests, the better we can also create value for them. We currently have around 90,000 professionals in our global network that are active, meaning they visit our site, our digital platform, verama.com, at least once per month to update their profile or to interact with us or our clients through the digital platform. On the client side, we have over 500 active clients. So it's a broad client base and is distributed across basically all industries. The markets that we serve are basically Sweden which is our main market. This is here we have our headquarter. This is here that eWork was founded. So of the 13,000 consultants and professionals that we have on assignment, more than 10,000 are working for clients in Sweden. And you can see the other countries as well. Norway, Poland, they passed more than 1,100 professionals on assignment in Q3, which is an important milestone. And Poland is the market that was added to the list of markets, the latest. We started up our business in Poland 7 years ago, and the company, as such, eWork Group, was founded in 2000. And we have been growing organically since the beginning. So this is the result of pure organic growth from the beginning. If we look at the industry segments where we operate, as I said, we basically have customers and clients in all industries. The public sector is important for us in Sweden and Norway. In total for the group, that accounts for around 17% of our professionals on assignment. In addition to that, in private sectors, we have manufacturing industries as an important segment, and other segments that are really, really key to us are telecom, for instance, infrastructure, engineering, and also retail and IT vendors. And IT vendors are both our partners and our clients. So we have an important role to play in supporting them. On the skills that we are focusing on and that we are looking for, our main area is in IT and all the skills related to digitalization. So system development, project management for typically IT and digitalization projects is really key to us. In addition to that, any expertise that can work with telecom development is also very important for us, as well as engineering and other skills related to infrastructure. IT infrastructure, as you can see, help desk and support, for instance, is a key area where we see many companies interested in outsourcing their activities and looking for skills and expertise. And we typically provide our professionals on an hourly basis, time and material basis, but we can also provide teams of professionals, or we can take on fixed price engagements, although that's a quite small part of what we do. Most of our professionals are working on a pure time and material basis. And our business model is based on pay when paid, meaning that we pay the professionals when we are paid by our clients. In order to help and facilitate early payments for professionals, and in particular for freelancers, this is of great interest, not the least in these days, in challenging times. We have a service that we call Pay Express, which allows professionals to get paid whenever they want to get paid at a certain fee, independently and regardless of when the client is paying for the bill that we send to them. So, to serve our clients and our professionals in the best way possible, we have a quite comprehensive service portfolio that we are constantly developing and upgrading. That service portfolio covers basically 3 parts: consulting services, managed services, and financial services. And consulting services is the part that holds the services that we provide to clients when they look for a professional or a team of professionals or a project. And here we are currently working our way through an updated portfolio to segment our services, meaning that we can be, for our clients, a broker. That's not typically what we are aiming to be, but we can be that. And that's a service that is developing into a digital service that we call e-broker. And this is tapping into the digital trend, where we see more and more clients interested and also capable to find talents through a digital platform. And our digital platform is called Verama. So this is a service that we can provide. Our experience, though, is that many clients need assistance and help in finding the right skills. So the next layer of services in this area is what we call consulting provider. That's when we can help and assist our clients in finding the best consultants for their needs. It can be a combination of an e-broker as a bottom platform and adding the consulting provider services on top of it. On top of that, we are now adding something we call expert provider, and you can see it all summarized in this slide. The expert provider is when we go out in the global markets to find the best experts in any field. And fields where we see great interest for these services currently is technologies like Java specialists, like cloud specialists. It can also be ERP specialists or other technologies where we search on a global basis to find the best talent for our clients. In addition to this, we are adding also services, for instance, related to background controls, security checks, and this is also an area where we see a growing interest among many clients, both in public sector and in private sector. Managed services are the services where we basically take on the full responsibility on behalf of a client to manage the complete sourcing and talent acquisition into an organization. And this can be either pure temporary workforce, what we call professionals or freelancers, or a combination of that and permanent workforce where we can help them recruit talent into their organizations. And when we recruit, we call that RPO, that's recruitment process outsourcing. We take on the responsibility to find talent to our clients' organizations. And here we typically work with CXOs, like CIOs, CHROs, and procurement directors that need help and assistance in finding talent, but also managing their entire talent pool and making sure that they are compliant with all the legislation that surrounds workforce today. And finally, financial services are the services that we add on to our consulting services and managed services, like, for instance, Pay Express, as I mentioned, to allow professionals to get paid whenever they want to get paid, but also insurance, liability insurance for typically freelancers who need to have a certain amount and level of insurance in their engagements. It can also be payrolling activities and loss coverage, new services that we are now adding in response to client needs and new updated legislation in countries and in the markets. So a very comprehensive portfolio that is currently being updated with a number of interesting services. I just want to mention finally the blue marked services here that are services intended for professionals and partners, where we also add new components to support them, for instance, in career planning, personal development, training activities, and so on. So a lot of activity going on here, and also with, of course, the development of our digital platform, Verama, which forms the platform for all activities and all the deliveries we do of services in our portfolio. So to summarize, we've been in the market for 22 years. We are leading in our industry. We have a broad client base. We have a great wide network of partners and professionals. And thereby, we can say that we know how these things work. We have the capabilities needed in terms of services to be able to provide good value to clients, partners and professionals, which means good value also to eWork and our investors. And by constantly developing and adapting to new opportunities and new need, we are also confident that we are well positioned for any needs and opportunities in the future, both today, tomorrow and beyond that. So with that, I'd like to hand over to Claes.
Thank you, Karin. So I will just briefly summarize our current performance and also our Q3 report. And giving some highlights on that, starting with the order intake. So in this period of high macroeconomic uncertainty, as we know, our order intake grew 18%. We see that the demand and specifically the client request that we get remained on a high level in that quarter, and that contributed to the increased order intake. We also see that the trend where we sign longer contracts continued in the quarter and contributed to the increase. We note that, and very positively, that also that the profitability of those orders booked was also improving and increasing. So that's some of the highlights on our order situation. The revenue in Q3 increased 24% to 3,482 million. The need for expertise is great, and we have gained increased trust from our clients, so that we can see increased volume growth. Volumes in terms of billed hours, and that's how we measure it, billed hours to our clients increased year-on-year 17% in the quarter. We also see that the average consulting fees are increasing, and that contributed with 6 percentage points to the revenue growth. During the quarter, we saw growth on all our markets, and it is our view that we continue to take market share to the benefits of all our stakeholders. The quarter's operating profit almost doubled, so strong performance. Important for that was the underlying positive profitability trend of our core business, as Karin spoke about. But also important was the development of our service portfolio, more specifically the growth of services to eWork service and PayExpress that contributed to the increased earnings. But not least important in this quarter was that our eWork's own cost as a percentage of revenue decreased compared to 2021 level, and the rate of cost increase was also lower than the volume increase. So the third quarter was strong for us, and it really constituted the true scaling of our business, and therefore also an improved operating margin. And then we move to... And speaking of the operating margin then, one can perceive that as low, but that is mainly explained by our business model inherent to that, and the important thing is the development of the same. And in Q3, the development was positive. We landed on 132 basis points, and that compares to the 83 basis points of last year. And even adjusted for some positive, not fully recurring items, we can say, in that quarter, the operating margin is clearly higher than it was last year. And it is this development of increased trust from our stakeholders, service development, and scaling of our business that Karin, myself, and the whole of eWork is determined to continue. Yeah, so we come to the end of the presentation. We were pleased to present a strong Q3 report and also see the great response it received from the market. We will release our Q4 report on February the 9th, and obviously hope to see as many of you as possible there at 1 o'clock. But we know that you all have busy schedules those days, and we will also provide a recording on our website from the presentation done in Swedish, so that as many of you as possible can partake in that. Thank you from us, and I think we now open up for questions, Simon.
Great.
Yeah.
Thank you so much, both Karin and Claes, for the presentation. Let's continue, and I'd like to stay on the demand side of your business. Is it fair to assume that customers increasingly seek consultants from relatively low-cost countries? And thereby, given that you are one or the market leader in Sweden within this space, they're also sourced from many countries. Are you benefiting from this?
Yes, that's a good question. During the second quarter of this year, we established a remote sourcing center in Poland, in Warsaw. And this was in response to increasing demands from clients to find talent in Eastern Europe, but it quickly turned out that they were not just requesting talent from Eastern Europe, but also from anywhere basically in the world. So we have typically requests from global clients in Asia, can be Southern Europe, can be anywhere basically. And we try to, of course, help and support them to the best possible extent. And our remote sourcing center is now our hub to do that.
And you recently finished, or at least reduced, investments in your product portfolio. You mentioned some of the comprehensiveness that you now have. Could you talk just in brief, what have you made over the past few years in terms of investments in the platform? Just in brief.
Yeah, so I can start off a bit. So we've been investing in a digital platform called Verama. And Verama consists of a number of different components. One is a VMS system, vendor management system, that we provide to clients who need support for managing their temporary workforce. We can provide that as a standalone software as a service, or we package it, bundle it together with our managed services and bring it to clients. And again, this development was in response to markets and clear client need to bring that to them. Another module is what we call supplier and client portal. This is where we post and publish all assignments from our clients, and where professionals can post and publish their profiles. So this is, in a way, the platform for the e-broker that I mentioned before. And then there is a third component, which is for our internal use, where we've used the system to support our delivery of services. That's what we call an ATS system. So we've been developing all three parts over the past years. Verama was launched in 2019, but before that, of course, a lot of hours were spent developing these components.
Thank you. And then lots of discussion currently is, of course, on the demand side. And looking at your year-to-date performance, it has certainly been strong numbers that you've been reporting. Could you mention anything on what you're seeing in the current market as of November or December here, and also speaking a little bit on the end sectors into 2023?
Yeah. So as I mentioned, there is a skills shortage. There is a need for skills related to important activities in digitalization, green transformation, also development of our infrastructure in society. That's what we tap into. And we see great need for the skills that we are focusing on and the areas where we are active. And that demand continues despite increasing uncertainty in the global world and in the Northern Europe region where we operate mainly. We see, of course, a bit of a mixed picture across industries. We've been working hard during this year to really close as many public sector frame agreements as possible in Sweden and Norway. And we've been quite successful in doing so, which to us is important because it creates a solid foundation for the future. In addition to this, as I mentioned, industry manufacturing is an important industry. Here it's a mixed picture. Also in the automotive industry, if we drill down in industry, we also get a mixed picture. There are clearly important projects taking place related to digitalization and the green transformation, meaning that we see clients that cannot afford to stop their projects because it's strategically important. But we also see in some places that some activities are being halted due to uncertainty. It doesn't mean that any activities are stopped, but really that they really consider and they use us for guidance and advice to a greater extent than we've seen in the beginning of the year. So it's a bit of a mixed picture, and we would probably expect that that continues for still a few months yet. But the important thing for our business is that we have a good and solid mix of activities across different industries, which gives to us a certain level of resilience, you can say, and stability in our business.
And I believe that resilience was also shown in 2020. Time flies, and we are unfortunately now out of time. But thank you so much for attending here today. I'm looking forward to speaking to you again in conjunction with the Q4 report.
Thank you so much.
Thank you for listening.
Thank you.
Hi and welcome everyone to ABG Sundal Collier's Investor Days. My name is Stefan Knutsson. I'm an equity analyst here at ABG covering the service sector. And with me today I have Prevas CEO Johan Strid, and we will listen in to him for 15-20 minutes followed by a Q&A session. So welcome Johan, and please go ahead.
Thank you. Good morning everyone. I'm Johan Strid, CEO of Prevas. I've been around in the company for about 4 years, since 2018. And for those of you who don't know Prevas by heart, I will just start by putting us on the map. We are a consultancy firm. We have about 1.3 billion Swedish crowns in turnover. We've been around since 85 and a public noted company since 98. We are 900 employees in Sweden, Norway, and Denmark. And starting with some big words in the beginning of our presentation, we are working with saving lives, improving the climate, and making society more safe. I will explain more later on regarding that. So that was us very briefly, but before going into details about Prevas, I would just like to paint a picture about the environment around us, and I picked a few trends that affects our customers, our partners, us as individuals, and also impacting on Prevas, of course. So these are a few of them, and it's quite a complex picture, of course. These trends interact and they counteract, of course, and there are some general patterns as well, and there are some overlying trends on top of this. For example, regarding demography, we're getting more people on the planet, we're getting older, we're getting wealthier, sicker and healthier, depending on how you view it. So that's one mega trend in itself, impacting a lot of this. There are also some economical trends, for example, regarding gig economy, affecting consultancy company as Prevas a lot. It's a circle economy, moving over to sustainability, which includes our customers and so on. And of course, there are a lot of technical trends as well. And general pattern going from the steam engine to the transistor to internet to artificial intelligence is that the pace is going faster and faster, and all these trends interact in different type of ways. So it's interesting. And you can be a little bit frightened about this, of course. It's about integrity. It's about security as well. But at Prevas, we have a positive attitude towards this. So this is our slogan, Hello Possibility. Look at the different possibilities that technology bring. And it's actually so important for us. So it's our vision, our driving purpose. Ingenuity will save the world. Being innovative, being creative, doing good things with technology and try to improve the world. And some of you might argue that we don't need to save it. Hopefully right, but we can make it better anyway. And these type of problems, regardless if it's a climate improvement or building a new factory in the middle of Sweden, the problems are so complex, so you need to interact with others. So it's important to have the ability to have good cooperation with others. And we want to co-create technological advancement for the betterment of all. Of course, it's about profit for our customers, increasing the revenue, decreasing the costs, and so on. But at the same time, we can aiming at improving the planet and also making better for people at the same time. So this is our mission. So what do we actually do at Prevas? Well, we're quite focused as a consultancy company. We have two main offerings. It doesn't include everything, but the general 80-20 rule. The first offering is about product development. We help our customers to develop products. These products are typical physical products. They include mechanics, design, electronics and hardware, embedded software and application software. And how this interact is really interesting and quite complex to understand how to do that in a good way. So this is one example, the inflatable helmet, a bicycle helmet from Hövding. We haven't done all of it, we have done parts of it, and we have helped the customer with that. It has some advanced sensor, it has built-in artificial intelligence, how to decide if the cyclist is falling or climbing off the bicycle, for example. And in this case, we have helped the customer to change the mechanics and the construction so it's cost efficient to produce. Their problem was that they sold all the helmets they had, but they lost money on each helmet. So we designed it in a way so it's more cost efficient to produce that. So that's a typical example. And many of the products that we develop are really, really complex and advanced. We're working in the medtech area. This is an example of testing for sepsis. Today it takes about 72 hours to decide which type of antibiotics to use. And our customer had a medical idea how to change that dramatically, but they didn't have the know-how how to develop an instrument realizing that. So they have used us as their development partner. We have done more or less everything from scratch, the design, construction, the mechanics, hardware, electronics, and so on, and also preparing the tests and verifications. So it's a long-term project for several years, lots of consultants. And now they have taken more over of the next phases and so on, and we have helped them building their quality system and so on. And many of these products are connected. We're working with Internet of Things, and it's about maintaining the products in a good way and having end-user relationships with the end users as well. So we have done about 8,000 different products. Sometimes we take responsibility for everything, and sometimes we provide a consultant on premise at the customer site. And since we have done this so many times for 30 years, we know the pitfalls. So many of the customers use us as their guiding partner. We know how to design it in a good way so it's maintainable, it's sustainable, and so on. And preparing certifications from authorities and so on. So that was the first offer. The second offer is about production development, manufacturing different type of products. And their drivers today is sustainability, but also flexibility. Their end customers want 27,000 of this one, 20,000 of this one, but next week instead. So it's a lot about flexibility and building factories where you can change your production all the time. And also about traceability and trackability. For example, if you're building a windmill and it falls down, you need to prove later on exactly which screws you used and the momentum you used when you screw them into the steel and so on. So it's about traceability and having the ability to track everything. And today it's lots about automation. It's a trend called blockification. You're moving the manufacturing back to Europe and to Scandinavia, and then you want a very high degree of automation. This is an example of a cobot. It's not a robot, it's a collaborative robot replacing the humans handling the robots. So that's where we are today. We introduced the first one in Sweden a few years ago. So it's a very high degree of automation. So what we do is typically we buy a robot from ABB on behalf of the customer. We customize it, we build a production line, we handle internal logistics and the manufacturing or management systems, improving and optimizing the manufacturing parts. So that's what we do. And we have different type of segments. We have several segments that are stable and they have increasing demand over time. Telecommunications, energy, defense, and in others you have food industry and government sector, for example. And the life science segment is also very stable and increasing demand. We are also working with engineering or manufacturing, vehicles and steel and mineral. They are changing a little bit more over time, but the underlying demand is increasing over time. And these are the top customers, the largest customers, but we're also working with startups in Uppsala, in Lund, in Copenhagen, and so on. So we're working with doctors and nurses who have ideas how to make a new invention, and then we become their development partner. So why does the customers choose us? This is a generic model. In general, they choose a vendor because they are the cheapest one, the best one, or you have the best relationships. Simplified, of course. And this is our positioning. We are aiming at being at the best in Stockholm, in Sweden, in Europe, or in the world, depending on the specific offering, and also have really good relationships with the customers. Many of the customers been around since we started the company or 25 years ago and so on. So we have common planning, roadmaps, and so on. And you might ask, well, can't you decide, should it be the best one or have the best relationships? Well, we are a network of 35 different units, and each unit has a clear idea of their positioning at the market. And when we combine this, we have a really strong combination of really good relationships and really good spearhead offerings. So it's a strong combination. And some other key aspects in our strategy. Adding value, I know it's a buzzword, but it's important in the consultancy industry to understand when you're relevant and when you're interesting for the customers. And we sell our time and our competence, but at the same time, we're building a structure capital. So we have instruments, laboratories, frameworks, reusable components, processes, and so on. So we don't start from scratch in each project. So we reuse the infrastructure that we have, which also means that we have a competitive edge compared to other consultancy firms in the exact spearhead offerings that we have. We are a decentralized organization. That means that each unit has an idea of their existence, how to develop their business, and then we combine this in a dynamic way. So we have a small central overhead, not trying to control this, but more facilitating the network. So sometimes the experts on steel industry in Karlstad, they combine their competence with a user experience specialist in Malmö, with a machine learning specialist in Stockholm. Then you have a really interesting combination that no other competitor has at that time. So nurturing the network, and also being attractive as an employer, that's the key issue. We have worked with that for a long time, and now we feel that we're really attractive and we have an inflow of talents into Prevas. And also action, trying new things and being innovative. So that was a few words about Prevas and what we do, for whom and how. So if we look at the perspective a little bit, this is our development the past years. The blue are in profit per quarter, and orange is our margin. So before 2018, we had a fairly bad performance. We lost money sometimes, and we had a low margin, and so on. Then we did a few changes in end of 2018. Then we increased the margin and the profit. And what we did here was that we prioritized profitability. And we did a few changes. We changed from a central organization to a decentralized organization. We simplified the organization and the processes. We reduced the costs. We reduced the overhead, mainly the central overhead. So we reduced that. And after a time, the profit level increased. Then we added a growth component. When you have about 10% margin or something like that, the next step is to grow your revenue and also grow the profit in kronor. So in the middle of the COVID crisis, we started our growth strategy. It's both about acquisitions and organic growth. And now we have about 12% margin and increasing the profit every quarter. So a few examples of progress this year. The first 3 quarters, we made 2 acquisitions in the spring. This is Q1 to Q3. We actually have done 2 more in November. So it's 4 different acquisitions this year. We have increased the ratio of women. That's a challenge that we have in our company. We were 17% in the beginning of the year, and now we're 20%. So it's a good progress, but it's still too low. And we have grown with about 150 employees, including the 2 last acquisitions. So we started at 750, and now we're 900. We have gained about 100 new customers the first 3 quarters. And we do have an active sales, but most of the customers are incoming. We are active on different seminars, conferences, and so on. And since we have these spearheaded offerings, we are well known for those, and potential customers contact us. And that's a really good start of a relationship. we are an active part in society, and it's mainly in our assignments that we contribute to a better world. One example in the steel industry, it's not very sexy, but it's really important to reduce the carbon emission in that industry. And we have a solution for that we actually own. It's used more or less in all steel furnaces in Sweden, and now we're moving to Germany, to Spain, and so on. And we charge for that solution, and we also have an incentive. If we reduce the energy consumption more, we get a bonus on top of that. So it's a good example where the customer win, we win, and the climate win. So we have trying to build that type of solutions. A few figures. We had about 10% margin last year. We increased that to 12% this year. We're increasing the profit and profit per share, and we're also increasing the service to investors. Being present at this type of presentation, having the reports in English, and so on. So that was a little bit about our development. A few words about our share. This is the development the past years, and it's more or less the same or correlated to increase in profit. That's natural. And this is compared to, not competitors, I would say, it's other type of consultancy firms and related to index as well. Now you might ask if it's too high valued. It's not for me to say, it's more for ABG or someone else, and this is some numbers on that. If you compare EV over EBIT, we have about 8.5, and the average is 12.5. It's a few weeks old, so it changed. I think the correlation or the relation is the same right now. So, ending up with the way forward. We got inflation, we have wars, a lack of components, and a large demand for know-how about technology, and also a large demand for companies who have the ability to apply technology and take on responsibility. It's not enough to know your Java programming or something like that. You need to understand complex problems and how to solve that and start a project for that. So we have a clear view on our market position, how we're working with employer branding, how to develop the company further. So it's about executing on that strategy and at the same time being agile about the type of business and business climate and so on. So that was Prevas, what we do, our development, and a few words about the future. I'm open for all type of questions.
Thank you, Johan, for a very interesting presentation. I would like to start off, you showed us an impressive graph there, or a chart with your EBIT development, and that the second part of that was to add growth. You have done a few acquisitions of late in November in Koteko and Myra Design. Can you tell us a little bit more about why you choose to acquire those companies, and also how you work strategically with assessing M&A targets?
Yeah, we're working continuously with that. And as mentioned, we are a network of 35 different business units, and we're looking for the next node in our network. And that node could be a complement to what we have today. Like Myra, they're working with industrial design. It was a competence that we don't have. So when we welcome that node in our network, the whole network becomes stronger. So that's one type of acquisition that we are looking for. And the other type is more about increasing the capability to deliver. And that was the Koteko case. And we're looking both for financial healthy companies like Myra, but also looking for turnarounds. More or less the same situation that Prevas was in 2018. Really good engineers, good customers, good solutions, but maybe not that efficient in the financial performance. So in our network, we can welcome them and they can perform better with the same type of business. So we're looking for both type of acquisitions.
Perfect. And then the second part of growth will obviously be organic growth. We have seen some macro headwinds of late, if you look for that. But in your point of view, how is the market that you face right now?
It's still very busy. That's the main challenge for Prevas and our type of companies. It's not a Prevas-specific challenge to finding the right employees that are dedicated and want to be a part of a company. So that's the biggest challenge. But we think that we are in a good position, and we have a lot of people coming back. I think about a large portion of the new employees has actually been at Prevas before, maybe a long time before or a few years back. So I think we're in a good position right now.
And if you read the reports from Almega, for example, they say that there is still a huge shortage of staff expected going forward, and that they see or expect solid order intake, whereas they are not that optimistic about price increases going forward. Is this a view that you share, or
No.
do you see something else?
No, I don't know, of course. It's a very tricky question. But so far, the important part for us is to have the ratio between prices and salaries remained or improved. And so far, it's been a really good discussion with the customers how to keep that. So we have a good relationship with the customers, and maybe it's dangerous to say, but I think it's been quite easy to increase the prices this year. How it will be next year, I don't know, of course. But the important part is to keep the ratio between salaries and prices.
Perfect. And then I would like to talk a little bit more about the EU initiatives that is launched in order to make the region carbon neutral by 2050. Is that something that you see act as a tailwind for you as a company, as the whole group, or just part of different segments?
I think in general it's driving a demand for changes and investments. We're active in the northern part of Sweden, for example, and a lot of in the manufacturing industry. And it's not only that, it's about choosing the right components when you produce or design products. So I think it's a strong driver in general. And this specifically, we're working with the steel industry, for example. So yes, absolutely.
And then you also released a few press releases that you won software deals that you have developed in-house and delivered to the customers. How is the business model looking for orders like that, and does it differ materially from what you usually offer the customers?
Yeah, we prefer time and material. I think that's the best business model for the customers and for us as a company as well, because many of the customers, they have a changing demand and then they don't know exactly what they want from the beginning. So trying to define that in a requirement specification is too hard. So it's good to have a flexible model, but then you can add incentives on top of that and bonuses and so on. So we're trying to keep it simple, and at the same time adding a few items on top of that. And I think that's a good combination.
So if you are successful in delivering those projects, there is a possibility that you earn a good profitability or better profitability in those contracts?
Yeah, sometimes yes.
Okay, perfect. I think we're running out of time. I would like to thank you very much, Johan, for coming and presenting with us here today.
Thank you. Thank you.
Welcome back to ABG Investor Days. My name is Simon Jönsson, an equity analyst here at ABG, covering small cap tech and gaming. With us next we have G5 and the CFO, Stefan Wikstrand. Without further ado, I'll leave the floor to you, Stefan.
Thank you very much. Thank you very much. Nice to be back. It's a nice tradition this time of year. So my name is Stefan Wikstrand. I'm the CFO of G5 Entertainment. And G5 Entertainment, we're a developer and publisher of free-to-play games for tablet smartphones, but also for PCs. We've been around for a while, so the company is 21 years old today. We've been in mobile, well, essentially since, well, actually before the smartphones came and became the prevalent type of phone on the market. But you can see the revenue chart here. We kind of distinguish the mobile gaming market as it is today with the smartphones. We are focused on a female audience of women over 35, which is also a core audience that we've been focusing on since we went into mobile. A few words on the kind of development of the market over the years. So obviously we're primarily focused on the red area here, the mobile gaming market, which has grown rapidly. This is also the popularization and the monetization of casual games, whilst PC and console games usually are different in the sense of type of games and how they're built. Mobile is more about the casual gaming experience. And the popularization and the monetization of this has created the growth of mobile. Since this chart, since this development, we also start to see a spread between these kind of platforms in the sense, well, you probably heard that PC games, some of the popular PC games have been ported over to mobile devices and become very popular. But we also see that mobile games, casual games, are being played and paid for on PCs. So PC is actually, or the Windows Store is one of the bigger stores where we sell our games today. So another look at the kind of growth of the market. This is a previous estimation of the market growth for the coming years. If we look at 2022, you will see a nice and healthy growth for this year. This will likely not occur. We've seen weaker seasonality over the summer, so these numbers are being revised. We'll more likely see a kind of a flat, maybe a bit declining year. Let's see how the numbers will be revised when we get them. But we expect kind of a healthy growth going forward, that we bounce back to growth after kind of a middle year, which is the first gap year that the mobile gaming market has had in terms of growth. Asia is the biggest market, but we, as the majority of the kind of Western developers, primarily derive our revenue from North America and Europe, which you can see in the bottom right of the slide. Asia, 9% today. If you back up a few years, we had more than 20% of our revenue coming from Asia. So Europe and Asia for us is moving a bit, but North America has been the dominant market essentially since forever, and for whatever reason, rest of the world is always 6%, and I can't really explain that part. If we look at G5's development, this is a bit more recent history than from 2009, but from 2014 when we moved over to the regulated market of NASDAQ. This is also coincides with us completing the transfer from premium games to free-to-play games in 2014 and 2015. We had a few successes earlier before 2014 in free-to-play, but this is where we kind of completed the transition over to only focus on free-to-play games. In 2016, we launched Hidden City, which is our biggest success so far. In 2017 and 2018, we spent a lot of time internally and revising our development department. We hired a lot more people. We changed the structure of the teams. We expanded the teams quite a lot to increase the quality of our own production of the games, which meant that we didn't release that many games in 2017, especially in 2018. But on the back of those investments, we started releasing games again in 2019 at a quicker pace. So you can see 5 games released in 2019 8 games in 2020 and so forth, whilst previously we did roughly 2 to 4 games per year. We also distinguish this when we do the revenue segmentation, which you will see later in the report. So games released from 2019 and onwards are classified as new generation of games. It's our own new generation of games. Games released before than the older games. And then we have the licensed games as well, but you will see that when we get to the revenue chart. So a higher pace, more games launched at a higher quality. Some successes. Jewels of Rome was one of the first of this batch of games that became very successful. Late in 2020, we released Sherlock, which currently is our biggest growth driver in the portfolio. If you see in 2022 there, you see another color, and also that there's only 2 new games released, which is related to what I hopefully will talk on. Oh yeah, we'll skip to this one. A slight change that we've done lately in the publishing strategy. So we've had this slide for quite a long time, which describes the revenue development of a free-to-play game. And the longevity of a free-to-play game is much longer than people usually expect. We see, for example, Secret Society that was launched in 2012 is still one of our biggest revenue drivers or revenue generators. Hidden City also grew very rapidly in the scaling phase. It reached peak revenue in 2018. You have a churn of revenue, but the curve tends to flatten out and the stickiness of the user base is very strong. You also, in that phase, you reduce or optimize your marketing spend, so the profitability of the games is much better. Why I connect this slide to the previous one is the first 2 steps here, which kind of describes what we've changed in the publishing strategy, which we announced in the Q3 report, is where where we previously came to kind of soft launch / scaling here. We released the games. We released all games in this phase, and we iterated on them in the market. We now will do more or less the same tests, but we will use them more for even stricter guidance in terms of if the games are going to global launch or if they're just going to be kind of early soft launch and retention tests. So we'll do more retention tests early with less content in the games. We'll test them, and then if they pass these benchmarks and proceed to the next level, we have some few iterations, and then they will go for global launch. That will mean that we will have fewer games in the market going forward, but hopefully at better quality. Whilst previously we released all of them in soft launch and iterated from there. So a slight difference, but this slight difference meant that we needed to also change how we capitalize on the games, and also we needed to take a decision what we do on the games that we already had started development, which you will see when we get to the financials part of the presentation. So if I then back up and go back to the target audience, that is the same. We have women over 35, which is our target audience. It is still a growing demographic, less and less underserved. There's a lot of companies that know that it's a very healthy part of the mobile gaming market. But still, you have a lot of developers coming to the market and focus on the games that they want to play, not necessarily what the kind of the audience wants to play. It's a very loyal audience, so when you get them on board, they tend to play the games for a very long period of time. So we're talking, for some, of course, they only play for a few days, but if you get some of these users on board, they play for weeks, months, quarters, some years, and that is the part of the stickiness that I mentioned before. Some people play these games for years and years. They invest in the storyline, they invest in the type of game that they enjoy. It's like a never-ending soap opera, and those we've seen around for quite a while. And they enjoy playing these games, they enjoy the gaming experience that we bring, and they then tend to play for a very long period of time. And we can see that when we get to games that are a bit older, that you have a very loyal audience, they spend really well, they can react poorly to significant changes to the game. They want to play what they kind of signed up for. So our main categories of games are Hidden Object games is the biggest category of games we have. It has almost always been the biggest category of games. It is a more niche audience or niche genre. So not as big as, for example, Match 3, which was one of the biggest genres. But very lucrative. When you get players on board, you have a good gaming experience. They stay with the games once again for a very long period of time. It fits really well with our target audience. Some of the games we have, the best paying audience is actually women over 55. But broadly speaking, that's the target audience that we're aiming for, 35 plus. So yeah, very sticky, very graphic oriented. So it's very good graphics in the game, not very kind of action oriented. Still calming, relaxing, which is what the majority of our players are looking for. A relaxing experience to kind of disconnect. Match 3 is our second biggest category of games, here represented by Jewels of Rome. Match 3, huge genre, obviously, so we have a much smaller market share in the Match 3 space, but also very much, a large growth potential there. Mahjong is Mahjong/solitaire is the third genre that we have. We sometimes refer to this as a bit of an evergreen genre. It's not necessarily, it's not huge. I think we're the biggest publisher of Mahjong games. A bit weaker in terms of KPIs, but people that like Mahjong games tend to stick with them for a very long period of time and keep coming back to the games. And I've said this before, for whatever reason, our Mahjong journey is a game that I come back to when I am on an airplane. For whatever reason, it fits there for me, and I come back to the game because it's a very enjoyable gaming experience. And then in the fourth category, we have the kind of new genres that we test, iterate, see if we can find a new success in a new or adjacent genre. Here, well, you have the word game that we release, and also you have a merge game, which is kind of related to the Match 3 genre, so adjacent and wordplays and new. All of these are connected with our social network that is built into the games. It's called the G5 Friends Network. And there people can socialize with each other. They can chat, they can befriend, they can help each other forward in the game. They can, of course, store their progress. It also allows for them to play cross-device. So you can play on your mobile phone, you come home, you move to your PC and play there, you can play on the web, etc. It also allows for us to kind of work with some additional tools when it comes to retention and re-engagement of the users. And we're adding more features here on an ongoing base. So we've added a form of kind of clans function, which is called unions in some of the games. So more features are being rolled out as well for the benefit of the gamer. I talked a bit about the publishing strategy before, that we have a slight revision there. That doesn't impact our overall strategy or that approach that we have, that we work with a portfolio of games. We will want to have multiple games in different stages. It creates stability in the business. So older games that are more mature, usually more profitable, then we can invest in new titles that emerge that will provide growth. So you can see here then the orange bar in the bottom there, which is the new generation of games that have seen very strong growth the last years, whilst the license primarily here has lost some revenue with the decline of Hidden City, but a very healthy situation. And in this case, also with improving margins, thanks to the gross margin improvement that we have between licensed and own games. If we then focus a bit on the new generation of games. So as I said, these are games that are released from 2019 and onwards. We get into a bit of a definition issue here with the 23 new titles. As I said, previously we released games in soft launch more on a kind of a global scale or with fully developed games, whilst now we switched the publishing strategy a bit. So it is a bit like comparing apples and pears, but we will live with that for now. Once again, we primarily invest in our main categories of games, Hidden Object and Match 3, and then Mahjong. And then we tend to release one, or going forward and testing, 1 to 2 games in a new or adjacent genre every year. The share of the revenue from these games have grown consistently since 2019. And now Sherlock is being the best growth driver. Before that, Jewels of Rome was big. Some others of the Jewels of games have also performed really well. And then this is then combined with the user acquisition efficiency that we've improved the last years. Starting from 2019, going into 2020, we invested a lot in the marketing efforts of the company. Marketing is a hugely important part when it comes to mobile gaming. Given the size of the market, the amount of games that are being released, marketing is crucial to be seen in getting the downloads, and we've done a lot of improvements there, which has had effect on both the efficiency of the user acquisition, but also the profitability of the group. So a few words on the financials. So in Q2, Q3, this year, we've seen a bit slower market, as I said before, on the market development. Q2 and Q3 are usually a bit weaker in terms of seasonality. It's warmer. We primarily derive our revenue from the northern hemisphere. So during summer months, people are outdoors more. They play a bit less. Winter months, Q4 and Q1, tend to be a bit better. That has held true for years. That effect has been a bit smaller during COVID. People have been indoors more, and they've been a bit more isolated, so they played more consistently over the year. We expected when we went into this year and you started seeing reopening and normalization that we would see a rebound to kind of more normal seasonal effects. So Q2 and Q3 a bit weaker, and then stronger again in Q4 and Q1. We see this year that seasonality was a bit stronger than we and other players in the industry anticipated. Probably because you had normal seasonality and then you had the reopening. It was the first summer in years in the main markets such as the US, where people could travel freely. And we've seen a lot of reports on the news about how stacked the airports in the US was. What you see here on the revenue development for us then, this is the SEK revenue development. As I said, we derive primarily our revenue from the US, so the USD is strengthened. So we still see growth in sequential growth here in SEK terms, but in the underlying currency, which is USD being our biggest currency, we certainly see a decline in Q2 and Q3. But it's a part of kind of going back to normal seasonal patterns and normalization after COVID. Sherlock has done really well. We continue to have very strong average spend in our games. So the MAGARPPU, which is the weirdest acronym, monthly average gross revenue per paying user, is a strong $61 per month. So the average user that actually spends in our game spends over $60 per month, which is very good. We see very good margin development. The gross margin continues to improve. You see a jump in Q3 2021, which is related to Microsoft Store lowering their store fees. But the trend is still there with the larger share of the portfolio being owned games, so we don't have to pay royalty on them. We see a very steady kind of increase in gross margin. In terms of EBIT margin, Q3 was very heavily impacted by some. We took a lot of write-downs in the portfolio due to this change in publishing strategy. So we cleared out all games that were not released from the balance sheet to kind of synchronize, what's going to happen in the future with the accounting. So that obviously impacted a lot. So we see a negative EBIT here of -22. Adjusted for write-offs, the EBIT margin would be a healthy 14% and FX, so around 50 million. We continue to have a very strong balance sheet. So we have a net cash position. We do our yearly dividends. We do buybacks ongoingly. So very kind of healthy position there. And with the change in how we capitalize and work with the new games, EBIT will actually even better reflect the cash generation that we have on an ongoing basis. And we have very good match between revenue and cost on an ongoing basis as well. So we convert cash really nicely, and EBIT will be an even better approximation for the cash flow going forward. So wrapping it up, I think, G5 as a company, we've been around for quite a while. We continue to be a very kind of stable player in this industry. We're profitable. We've been for years. We're cash flow positive. We have a very strong balance sheet. We pay a dividend. We do buybacks. At the same time, we're kind of investing in the business at capacity. We have a workforce today of around 950 people that work on the new games. We have kind of fully stacked teams where we need them for the existing games, and we have the new development teams that takes new games to the market and gives us a shot for the future. We have a very positive development in the product mix, which you can see there with the new games or owned games in general are growing, taking a larger share of the portfolio. So we see increase in margins from the gross margin side. And then we have the upside potential, which is the beauty of mobile, that when you have a runaway hit, you have the disproportionate upside potential where you don't have to add cost to scale a new game, apart from marketing. But of course, that happens when you scale a game. But the kind of OpEx part of the business doesn't have to grow with the growing portfolio of games. So we essentially invest new games in marketing at capacity or as much as we can to kind of fuel the company, and at the same time we're profitable and cash flow generating. And I think that kind of was me. Nailed it. 17 minutes.
Yes, you did. Thank you, Stefan. We have time for some Q&A as well. So I want to start off with Sherlock, your biggest growth driver right now, at least. What is your plan to keep growing the game?
Well, I think for Sherlock, it has been growing for quite a while. Obviously the marketing team works really hard at kind of marketing, getting new users to the game. At the same time, the team that is responsible for the game, they're certainly fully funded and maybe even done some to kind of make sure that we have this kind of content treadmill going, that you have the monthly releases, updates that the user wants to have in the game to engage them. But also it, of course, then maximizes our revenue potential for the game. So I think it is a mix between having the team there to just give the game the best shot it can, and then marketing does their thing on their end, so to speak, to get new users in. And then where the game will go, we'll see. It's been a very steady growth driver for us, so growing kind of month to month consistently. So yeah, we'll see.
Is it still growing month over month?
Well, it did up until Q3. Q4 you will have to wait for.
All right. And what is your overall market outlook right now in a broader sense? Q3 was in the broader market a weak quarter in terms of growth, 13% decline year over year, according to Sensor Tower at least. Do you think the growth rate could be better year over year in Q4?
I do, but not with kind of leaps and bounds. I think at least we saw some trends that it wasn't, we had some reopening effects late Q4 as well, especially over Christmas, New Year's holidays, whilst they can be very strong, kind of sending off the Q4 with a kind of really strong end. Maybe that has normalized a bit this year as we've kind of gotten into this kind of reopening phase. But yeah, I think it's certainly not by leaps and bounds. It is still a bit of a sluggish market. I think we see some macro effects coming into play. I think summer quarters were more related to kind of reopening. We probably see a bit macro impacting us, but on the other hand, you have positive seasonality, which we kind of expect to come back. So it is a mixed bag. It's not easy, and I think you see that as well when we look at the forecast for Q4 from kind of other market participants, that they deviate a bit, and it's a bit unclear on where we're going.
All right. And a last one from me on ad revenues. Still kind of an untapped opportunity for you, I think. It's around 1 or 2% or something of sales.
Around
I think.
1, yeah.
Quite low compared to competitors. What could the optimal share between in-app purchases and ad revenues be for you, looking 3 to 5 years ahead?
Well, we certainly want to see the ad revenue growing, but as we said before, we don't. You see a lot of companies kind of that have the same type of games that we do. Not the kind of purely ad-driven games, but more kind of targeted towards in-app purchase, casual, same target audience. That it's not uncommon that you see 15 to 20%. We're very focused on the in-app purchase part of the games. So as we said before, our first target was to get to 3, then kind of maybe moving it up to 5. Let's see how that when that actually occurs. We certainly want to grow it, but I don't foresee us kind of coming to that, being on par with our market. We're quite conservative when it comes to how we do advertising revenue in our games, and I don't foresee that we would change that dramatically, and then you kind of limit your potential in that sense. On the other hand, you maximize the potential on the in-app purchase side. And that's certainly a discussion that we have. But so growing from here, I think the other part that we're very proud of is the development of the G5 store. So in the Q3 report, we said advertising and G5 store combined was more than 5%. G5 store, which was launched summer 2020, has also grown month to month ever since, with one exception. It was 1 month where it didn't grow, and that continues to grow. And the margins there are much better. Then we're getting comparable to advertising revenue and the gross margins that you see there. So the combination of the two is quite interesting, and where the G5 store is focused on in that purchase part, and then you have advertising revenue, but both give the kind of gross margin expansion that you want to see. So we certainly expect both of those to grow as jointly, but probably that G5 store will outpace the growth, so it will grow faster. And let's see where the kind of limit is there, but it certainly looks very healthy.
All right. Thank you, Stefan, and thank you, the audience, as well.
Thank you.
Hi everyone, and welcome to ABG Investor Days. My name is Nikola Kalanowski, and I'm an equity research analyst. With us today, we have Michael and Johan from Nona. They will give us a brief presentation and then a demo. So please take it away.
Thank you very much. My name is Michael Kolaros, one of the founder of Nona. So we will do like an introduction of Nona today here. Together, I have my colleague Johan with me, and I have a background as an entrepreneur for many years, and we will talk a lot about AI and machine learning in this presentation. So, Johan.
Thank you, Michael. My name is Johan Stille. I joined Nona this year. I have a background from larger enterprises. I recently came from a company called Ahlsell, the largest technical distributor in the Scandinavian area. And I was instantly attracted by Nona when I met the founders here the first time. Because in my recent career, I've found words like machine learning, AI, big data, a bit abstract and a bit fluffy, so to speak. And when I met Nona, I saw almost for the first time in my life how these technologies can be used in a very concrete way, applicable for companies and adding a lot of values for the companies. So that attracted me a lot. We will do an introduction, and then we'll try to do a live demo. We know we're not supposed to do that, but we will try it anyway. Hope that's going to work fine. So what we're talking about here is business intelligence or market intelligence tool for fashion retail companies. And why fashion retailing? Well, it's a very interesting industry for us. First of all, there's a lot of actors, thousands of actors in this industry, which is of course good for our tool. And also it's an industry that is based on speed. There's a lot of speed in trends, it's speed in seasonality, and there's also a paradigm shift in this industry that we all can read and hear about, where new actors are coming in and disrupting this industry. They work in a completely different way, data-driven and with shorter lead times, etc. We provide a unique BI tool for this market where they can, in real time, daily, follow the competitors and the market data. We'll show you that later. The tool itself has a stickiness to it because the customers using it today experience that they start to navigate their business based on the insights of the data. And once you do that, you get very dependent on this data. So from our experience, once you get this type of tool, you stick with it. And for me, joining Nona, it was interesting with the team starting it, Michael and Jonas sitting over there. They are experienced senior entrepreneurs, which is very good. They have a very sound and very solid and mature way of driving this company, which I personally like a lot. The company is beyond the technology phase. They've been working 4 years to build the platform, and we have, as you see in the below here, already been acknowledged from that work. We've been the startup partner of the year by IBM, and we have also been selected from Goldman Sachs to be one of the most disruptive technologies of 2022, which is great. Today, we gather data from almost 600 brands, and we daily collect data on almost 40 million items, and that's quite a lot. So what these fashion retailers, what are their pains? They have a lot of pains to work with today. These are some of them. Pricing, of course. How can we have a more relevant price points on our products in each category and in each geography? And Nona helps with that. Do we have any gaps in our assortment? The assortment's too wide or too narrow? You could see that from the data too. How do we work with discounts? How do we avoid over-discounting, which is a severe problem in this industry? What are the trends and how can we utilize the trends and navigate after those trends in our work? and how do we match these data-driven new competitors that we are facing out there. So the tool we have, our platform, helps our customers in several ways. Used correctly, the tool helps them in all of these areas. Of course, the improved pricing that we mentioned, and we will show you later how that looks in reality. Also, the discounting side, you get a full view of how all the actors that you want to benchmark, how they work with their discounts. You could follow trends, and I will show you how you could actually follow a full product lifecycle in this system based on the data. It helps you to optimize your assortment in all different aspects. And if you do this correctly, of course, it gives you a higher sell-through. So a lot of strong fundamental value drivers for the users of this tool. It's a very broad tool, so to speak. It can be used for strategic work when you launch in a new geography, you enter a new country, or you launch a new assortment, etc. But it could also be used on a daily tactical level. In fashion retail, they call it in-season or out-of-season work. And this data you could use in the full range of strategic to tactical work. And this is a bit of the magic. I remember when I met Nona first time, I could understand that you could see the data. You could see my jacket on a website, and you can collect that data. But they also told me that they know what is selling and not selling. And I was quite curious, how do you know? You don't have sales data. How do you know that? And it was a bit simpler than I thought. Actually, what we do when we look in a website, a web shop, all web shops are built on a popularity pyramid structure. So all web shops are moving items upwards and downwards based on popularity. It's natural, right? Since we are scraping and collecting the data daily, we follow the movements of my jacket or Jonas' jacket. And we could see that Jonas' jacket is up, is going up in popularity, and mine is going down. We give these products ranking points. We also measure if replenishment, if mine is sold out and is refilled, it's a good thing. If my jacket spins off to several other variants, it's a good thing. So we can actually see what is popular, and also that is usually the same thing as is selling a lot. And our customers confirm that every time. We see introductions, all new launches you could see in every aspect, and you could see also phase-outs. So use it correctly, you could follow a product life cycle or a category life cycle in every fashion retail category. Some existing customer cases. The tool was finished technically this year, so this is the year when we started selling the tool. Of course, we started off with some Swedish customers since we're a Swedish company, but this year we've expanded and started generating international customers. These are some examples. For example, Bogner, an old skiing brand, outdoor brand in Germany, and they wanted to find out if they could reduce assortment. The hypothesis was that they had too broad assortment in different markets, and they saw that from the data, and they could reduce assortment in some areas, in some categories, and by that they reduced cost and increased their margins, and had a very, very short payoff time of the tool. Bimba y Lola is a fast-growing Spanish fashion company. They had a problem with growing, that they didn't know the correct price point in new markets. What should be the price point in US or the price point in the States, etc. And by looking at price benchmark towards their peers, they could see this is eventually the right price point in a country versus another country. And they got a massive markup instantly by changing the cross-border pricing. Marimekko, as you know, a famous Finnish design company, they worked with Nona finding markup potentials in general, finding a little extra margins here and there, and did that successfully. They now recently asked us to expand from fashion into home interior which we are doing right now. So the methodology we have, we can expand to other business areas. And Michael, can you explain how it really works?
Yes, now we will talk a little bit more about technology, how we're actually doing this. So we're collecting a lot of data all the time. So for example, for H&M, we collect the data in Sweden, in Germany, in France, etc. Every day, 24/7, we're collecting all the data. It's all images, it's all text. And we have built a very advanced pipeline that we're sorting all the products. To sort it is like the trick here, actually, because when we talk to our customer, they have an internal data structure. So we map that structure to the market, which means that they actually can do one-to-one. And then we present that in a tool that we call Known Analytics. And I will show you that in a second. It's a lot about talk about AI, machine learning, deep learning. This is actually a deep learning model, and this is the Zalando assortment. This is how a Zalando's assortment looks in a deep learning model. Just using images, we can sort the whole assortment out, and we can break it down. So our AI model is looking, I think today, 1,700 different properties. And we're using some part in the text, some part is just in the image. We're sorting everything out, and then we use that information in the system. So my idea now is go directly into the system.
Good luck.
Yeah, thank you.
And I can say a bit of this magic is that we, of course, collect all text, all data, all images on an item. But since we're also scanning the picture, we take out data points that are not even presented by the supplier itself. It could be arm length, shirt length, neckline, etc. So we get more data than is actually published.
So right now, I have logged in as Zara. Why I'm showing you Zara is because they are super successful right now when it comes to pricing. They have super high margins, and we've been looking at them for a year right now. So they have reduced the assortment and raised the prices on all market, and that's quite interesting. So we have some customers actually using Zara as a role model, country by country, to understand how they're doing the pricing. So this is like the last quarter, because I know they did a record result the last quarter. So we can see here right now, this is the first view when you log in. So this is the Spanish market right now. So what you can see directly here on the Spanish market, 24% is out of stock. You can see that the average discount right now in Spain is 42%. The discount with is 32%, etc., etc. So you got a lot of interesting information directly. So if I click here on Zara, for example, you can see all interesting KPIs category by category. And you can see here actually that they have raised the price for the last quarter a lot. For example, here for dresses, 76%. Quite interesting. And the beauty with the Nona system is always when you see a number here, you can always click on... Oh, sorry. You can always click on all the numbers. So this is actually the product. So I clicked on dresses, and you get all the 780 dresses that is sold the last quarter. And you can go all the way directly into the special, to the products. So in this case here, I went from an overview in Spain directly down to this product in Spain. And we first observed this the 29th of September in Spain. You can have the price history for it. And you also can have all the product detail. One word about AI. So some parts we get from the text, but for example, when it's come to the dress length, for example, most of the time they don't write it. So there is one model just measuring the length of the dress, for example. We have one AI model looking at the pattern. We have one model just looking at the fabrics, one looking at the color, etc., etc., and breaking it down to enormous amount of different properties. So this is just one example. But we can deep down a little bit more. It's quite interesting. They've been very aggressive on dresses, for example. We can go in here, for example, to look at... we have a lot of here, you can see pricing and assortment tool. We'll just show you a couple of them. We can have, for example, go in and look at the price architecture in Spain. So just one second. So we can see here, this is actually the price distribution for the last quarter in in Spain. So you can see here, for example, that between 100 to 300 euro, most of the products, so they have like a distribution there, and it was like 94% was between 0 to 60 euro. And you can have a look at that, and you can always export that out. So if I click here, for example, we can look a little bit more on all markets, for example. Sorry. So this is quite interesting also. What I can see here, for example, that they have a little bit different price architecture from Spain to United States. So what I can see here directly actually is that they have a higher price point on the US market. Quite interesting. That means that they have different price strategies for different kind of countries. And you can even deep down a little bit, deep down in this a little bit more. So now we're looking at...
You see up here all the time what you're looking at. Now we're looking at bags in Spain, but we could choose trousers in Italy, or we could choose whatever.
We show, I think we go to dresses instead. So now we're looking, I went from bags to dresses right now instead. Just 1 second. It's a lot of information. So what you can see here, so this is actually dresses from, so your point of view right now is Spain, for example. So what we can see here immediately, when it's come to similar dresses, we can see that the price points are much higher in other countries. So they have a 33% higher price in France, and they have a 50% higher price in the United States. And this is actually for the same dresses. We have an AI model just going through all the sites to see, is it a similar dress or not? And then we can match them, and then we can have a look. And now I'm also looking at bag sales. Sorry, it was like a bad
This is a very popular analysis where you could see how your competitors are pricing cross-border, and you could follow if you have a peer that you really want to benchmark, or you could set your own standard in that market.
So in this example here, we can see, for example, that this actually dress is priced 72% higher in the US market. Quite simple, you can do that in real time, so we can look at today or historical data all the time. And you can see the changes. So we have been looking at Zara, so they have raised the price a lot, actually, for the last year in many markets. So this is just one example how you can use the data, and we're using the same data all the time. So we've been collecting the data, we resell it to other vendors all the time. There is companies here actually this disrupting the retail industry right now. Mostly it's Asian companies. We have a company called Shein from China. They go from H&M is calling themselves a fast fashion company, but Shein see themselves as a real-time fashion company. So it's take them from when they see a trend, it take them 48 hours to produce that. So they are super, super fast right now. And then it's become super difficult for a company like Zara and H&M, you know, really to follow them. This is a super interesting analytics that we're doing right now. This is what we call product ranking. So for the last quarter, we're doing algorithms to understand what is actually selling right now. So in this example here, we have a list of the best-selling dresses on the Spanish market. This is that kind of technology these Asian actors is using. So they try to understand all the time what is selling in dresses, in trousers, in Germany, in France, and then they're doing similar product, and they skip all the product that don't sell. That's the product that Zara and H&M can sell. So they just take the best-selling products all the time, doing similar product. And Johan were also explaining that we were looking mostly on the hierarchy to understand actually how the movement is. So we have algorithms to understand the movement all the time. So if you really can act on this kind of information, you can do amazing things, actually. So this is just one example.
And I think it's we can finish off the demonstration there.
Yeah.
This is like we said, this is where our customers are challenging us. We're actually telling them this is what you are selling the most, and then there's normally a CFO there who's a bit curious, and then he looks in the figures and confirm that is actually correct. This week we signed Canada Goose. Interesting user case. They are a premium brand. They want to follow their own products through the retail platforms around the world, so they know what assortment, what product info and what prices the platforms are using. So that's a very specific user case, and we can help them with that also. So we try to show a variety of user cases that could be solved by using this data in a correct way. Thank you.
Thank you.
All right, excellent. Thank you very much for the presentation as well as the demo that you just showed. So if we delve into a few questions here for the remaining minutes of the presentation.
Yeah.
My question is, you are a young company and you have the opportunity to grow very quickly. Now, if we go a little bit long term now, you know, how do the economics of the business look like? Could you delve in a little bit into that aspect?
I can do that. It's looking really good. This is a SaaS product. We have a very low variable cost connected to each new customers in general, and specifically since when we collect data, we get data for a lot of peers or competitors, and we can just reuse that data to sell it over and over again to several actors. So in our case, in combination with a low cost structure, we have a very high profit margin based on a very high growth margin. We expect to be around somewhere between 75 to 80% growth margin.
And again, onto the fact that this is a rather novel type of product in Europe. Is there a clear-cut competitor, or has the competitive landscape not been fully defined yet? What is your view on that?
I think actually collecting data, it's a lot of companies actually collecting the data. So there is like some competitors in this area, but I think the way we're doing it, using like very, very advanced machine learning and sorting the product, it's quite easy to collect the data. The difficulty is actually how to sort the data so it fits our customer. So I think from our perspective, it's super good to have your competitors, but if we're doing this, you know, the best way, I think we have a strong journey.
And the philosophy of the company is not to drive innovation. We drive customer value. So in that sense, as long as we can drive customer value, that's the most important thing for us.
Yeah. And in retail in general, what I guess investors and chief executives and so on take a look at is, you know, typically inventory levels. You know, how can your product, you touched upon this a little bit, how can your product sort of help alleviate any inventory management issues and so on?
Yeah, but we strongly believe that if you really use these insights and this intelligence the right way, you will have a more relevant assortment and relevant price level, and you could follow your product life cycle, and by that have a better economy in your stock. But also, I think these companies need to speed up lead time. So if you combine speed and relevance, you would be successful in the future in fashion retail.
And there is like companies like Shein, they don't really have inventories because, you know, they're doing, you know, fashion on demand. So it's like a new way to work, actually.
Yeah. Well, that all sounds great. I think that we're out of time right now. But thank you, everyone, for listening, and for everybody online. Thank you very much.
Thank you for inviting us.
Yeah, thank you.
Hi and welcome everyone for the next presentation. My name is Daniel Thorsson, analyst at ABG, covering IT and technology companies. And with us for this presentation we have Proact and the CEO Jonas Hasselberg. So I let you go ahead with the company presentation and I have a couple of questions in the end.
Fantastic. Thank you. And thanks everyone. Good morning. Thank you for having us. So my name is Jonas Hasselberg. I'm the CEO of Proact since a little bit more than 4 years. I'll talk a little bit about the market, the company, of course, some of the progress we made, and we'll touch on some of the financial numbers. And like you said, Daniel, we'll leave some room for questions at the end. So for those of you who don't know us, we are 29 years old. We're an IT solution provider based out of Stockholm, but we operate out of 13 countries in Europe. We have a customer base of large and medium-sized enterprises, public and private across our regions. We're turning over about 4.3 billion Swedish kronor on a yearly basis, and we're employing 1,200, a little bit more than 1,200 people across these countries. Our employees are highly skilled, very technical and skilled experts in the area of IT and IT solutions. I'll just very high level talk a little bit about where the market is going, and this won't be news to most of you, but there's a couple of drivers that are important for Proact in terms of our business and our growth. Number one is that all our customers are going through some sort of digital transformation. A lot of it is driven, of course, by improving their business. Could be simple things like better decision making by getting access to data, automating processes, improving production, putting a lot of AI or innovation tools into work of their business. Everybody wants it to be sustainable. Of course, sustainability is rapidly increasing. Many of you know that IT and data centers are consuming large amounts of electricity. So a lot of drivers is just to be more efficient from that perspective as well. But obviously, ultimately, business innovation through IT. And that's the business driver for us. There's a technology driver in our industry, which is driven by what's called cloud, but cloud needs a little bit of a clarification. We use terminology like hybrid cloud or multi-cloud. And the point here is cloud is not as simple as just going to the Microsoft cloud or the Google cloud. Most of our customers are living in a mixed world. They want to use Google or Microsoft or Amazon for large-scale general purpose things, but at the same time they may have applications and legacy systems that are very old that cannot move easily, so they continue to run a lot of their IT in their own data centers. They may have regulatory requirements that data needs to be within their own jurisdiction, or they want to have data in their own control. So everybody's going to live for quite some time in a world where they have IT infrastructure in their own ownership or in their own premises. They're going to leverage the large public cloud providers like Google and Microsoft and Amazon, and they're going to use companies like ourselves to make all of this actually work together and data and application to be transparent and flowing. So the technology trend is very important for us. Some may think that it's becoming easier and easier for our customers. Fortunately for us, it's the other way around. The world becomes more and more complex from a technology perspective. The innovation pace is incredibly high. The complexity of managing old legacy infrastructure, regulations and business requirements with the speed of innovation that we see in technology is difficult for our customers. They need partners like ourselves to help them navigate this. The third trend, which is maybe the less positive one, is obviously the ever-increasing threat of cyber attacks and the need of having a high degree of cyber protection for our customers. Another opportunity for us, but obviously not necessarily a positive thing. So these are the three high-level macro trends that drive our strategy, but also drive our growth opportunity. So what we do, we are a specialist. We are not a general purpose provider. We are very much geared about helping our customers get value out of all their data. That still means that we deliver IT solutions, and we would do basic reselling of infrastructure, so servers, storage solutions, networking equipment. But more and more, of course, we deliver IT infrastructure as part of a service. So the customers buy it as a service from Proact. We deliver hardware and software, servicing them, deliver them as a service. We deliver technical support and more, of course, consulting services, so helping our customers navigate the ever-increasing complexity of IT. And all of that around a couple of value propositions, helping our customers design their strategies, helping them store their data in a secure way, helping them get access to that data in an effective way, so networking and connectivity, protecting, as I touched on already, so the securing of the data, and ultimately getting the value out of that data. So we have a couple of very crisp value propositions. I won't go through this busy slide in detail, but we have a range of offerings that cover this whole area. Everything from storage solutions, networking solutions, disaster recovery, server solutions, artificial intelligence platforms, cybersecurity and protection solutions. We have a very complete portfolio, and where we allow our customers to select whether they want to own the equipment and run it on their own in their own environments, or if they want to buy it from us as a service. So we're pretty agnostic to how customers consume their IT. We want to deliver the value to them and fit their particular strategies. And here's another way of depicting this. So this environment is becoming more and more clear. I'll give you a pretty crisp example of my former employer. I used to work at a company called Telia here in Sweden. Some of you may know them, a big telco. Telia has an interesting range of IT solutions. They have thousands of applications, of course. It's a large company, complex operations. Some of those IT systems ranging from the year of 1967, so old mainframe solutions on one end, and obviously they're using public cloud and super modern IT on the other end, you know, the latest and greatest, if you will, from companies like Amazon and Microsoft. And managing that whole environment is a non-trivial exercise, even for a large company like Telia, and they're therefore needing to really be able to work all the different aspects of their IT infrastructure and get the best value out of every investment. So we deliver this from 4 different delivery hubs. So we have service delivery operations in 4 main hubs: Sweden, UK, Netherlands, and Germany. And hereby we can then deliver packaged and standardized managed services to all our markets across Europe. And this is a good way for us to get scale, efficiency, and also be able to standardize the way we deliver our service to all our customers. And one thing we haven't spoken about in large detail is our security offerings. This is, as I mentioned here in the beginning, an increasing demand, of course, and frankly, quite difficult for our customers to manage themselves. Obviously, cyber attacks don't rest over weekends. They don't rest over non-working hours, over the nights. This requires 24/7, every day of the week attention. And it's relatively difficult to both identify attacks, but also, of course, remedy or respond to an attack. So we run security operations centers out of our UK presence that cover all of Europe. So we have very skilled people coming out of with frankly specific cyber security training out of university that run out of our operations center. So we can then help our customers to both identify security threats and respond to them on a 24/7 coverage basis. And this is a very good and positive strength of ours, and something that is frankly quite difficult for enterprise customers to manage themselves. So something we may not have spoken about as much as we should have, but one of the key assets and key expertise areas of Proact. We have a strategy of growing, and we have a strategy of broadening our offerings to our customers. We accelerate a lot of that through acquisitions. So over the past 3 years, we've acquired 5 companies across Europe, all of which are both actually gaining some market share for us, but also bringing new skills and new offerings into the company. The first one was a company in the Netherlands called Peopleware, very strong in providing managed IT infrastructure and managed workplace solutions to enterprise customers based on Microsoft. So a high degree of cloud-based skills and expertise. We acquired a company in the UK called Cetus, based out of Manchester, also very good in hybrid cloud solutions. So really able to help customers with that hybrid environments where things need to work together in a transparent and integrated way. Here in Stockholm, about 2 years ago, a company called Conoa, super skilled, probably among the best in Europe around what's called cloud native application development. So they're helping customers develop platforms for rapid application development. And we have customers that traditionally would spend several months on updating their applications and bring this down to days or weeks with these types of platforms. They're speeding up the innovation pace drastically by just using modern and cloud-native application development platforms. And then in Germany, exactly a year ago, a company out of Dortmund called AHD, also a managed services provider of enterprise-grade solutions. And then last but definitely not least, earlier this summer, or earlier summer of this year, I should say, a company also in Germany called Sepago, a highly skilled consulting company with focus on Microsoft and workplace solutions. With the two latest companies also not only do they bring great expertise, but also give us a very good presence in the German market. It's obviously one, if not the largest IT market in Europe. Highly regionalized, it's important to be present across all the geographies, all the regions of Germany, and now we have a good presence and quite a footprint in the German market. And then these numbers are getting a little bit old because it's from our third quarter. We'll announce the fourth quarter, of course, here in the beginning of next year. But tremendous growth during this year. We're growing with about 30% year to date and 36% in the individual quarter of Q3, partly through the acquisitions, but a very, very strong organic growth as well, which has been fantastic. Partly because there's huge demand in the marketplace, which we've talked about a lot. Obviously, we're coming out of COVID as well, and we see a much higher pace in the marketplace than we saw during the years of pandemic. We're also growing the contract value of cloud services. So for those of you who follow us know that we talk about something we call total contract value, or TCV. It's the value of new contracts that we've signed up in the quarter for cloud services. We had a very strong quarter in Q3 with new contract value of 158 million. And good growth thereby in our services. We're, since a couple of quarters back, communicating a little bit more clearly what we call recurring revenues. So revenues that are under contract, which is obviously much more comfortable for me and everybody else, that we know that we have customers that are paying on a monthly basis, not on a transactional basis. Good growth also in what we then call ARR, or annualized recurring revenue. We're now just short of 1.5 billion in terms of yearly revenue that are under contract from our customers, which is very positive. And then last but not least, for those of you who remember, about a year ago we came out with a profit warning because the semiconductor deliveries were impacting our industry. And even though we've been closing deals at a good pace of Q4 of last year, we couldn't deliver them on time, and things slipped into this calendar year. We've now seen the semiconductor situation during this normalizing. We had some backlog throughout the first quarters of the year, but we've also been clear and seen that the situation is improving here during the second half of this year and continue to improve. So we're pretty much on normal delivery times now for equipment and semiconductor, which is great. So that problem, if I may put it that way, seems to be behind us finally. So good third quarter and overall a good traction in the market coming off of the pandemic, with both organic growth as well as acquired growth for the company. And that was it, Daniel. Quick and hopefully concise.
Absolutely, that's great, Jonas. I have a first question on the semiconductor situation.
Yep.
You have a strong order backlog that you are delivering on, so sales growth is going to look nicely ahead. It was strong growth in the past quarters as well. How is underlying new order intake progressing in Q3 and Q4? What do you see?
No, we've seen a good activity in the marketplace, so which is positive. So it's not only that we deliver backlog, we also see good activity in our customers for closing new deals. It's been a good market all the way up to Q3, and we'll continue to see a good market. Obviously, we don't give any forecasts, as you guys know, but it's been a good good activity in the marketplace throughout the year.
Yeah. And to understand geographically a bit, your largest market are the Nordics, UK, Germany, and Netherlands. Do you see any change in customer behavior throughout 2022, or do you have the same growth pace in all of the regions?
It's roughly the same growth pace. Some have been, and we have slightly different customer demographics in our different regions, so that's visible. Sweden, typically very large enterprise customers. Netherlands, to contrast, a little bit more mid-sized customers. So in Sweden, we would still have quite a bit of systems business or traditional reselling, whereas Netherlands is way ahead in terms of cloud and managed services. But good traction and growth in all our markets and very positive momentum, I'd say.
And looking ahead a little bit, in a slower growth or lower investment period for corporates, is that mainly going to hurt your systems business or your service business? Or how should we think about kind of next year, for example?
And I think so this is a little bit of a tricky one, I think, and I won't be able to give a super straight answer. I'll actually give a double-edged answer, just to cover all my bases. Clearly, the recession and inflation is a risk for everyone, including ourselves. I think we'll see if there is a negative impact. We'll definitely see it impacting systems and possibly our consulting business. If I reflect back to the beginning of COVID, where we thought the consulting business and the systems business were going to get hit most, we didn't see it. So that's the flip side of this coin, that we do see a lot of customers continue investing in IT and transformation to become more efficient and come out stronger out of a recession. So the possible upside is that our customers continue investing in their transformation so that they are stronger after the recession. But if something happens on a negative basis, I think systems business is obviously the more volatile and sensitive. Cloud services, support services are under contract. We've had a very strong year this year in terms of closing new cloud contracts, so we should be able to monetize on that during next year.
I see. Given your value proposition, do you think that you help your customers being more efficient or helping them to grow their business? Because I guess that lots of the customers and corporates in Europe here next year, they're going to aim to become more efficient in the market that is slowing. Do you help them with that, or rather drive growth for them? Or
both, and I think historically it's been more on innovation and growth, but it's not unrealistic that as we look into next year, there will be a lot of work around being more efficient. Both are, of course, good business outcomes for our customers, and ultimately, that's the most important thing for us. We don't do IT for the sake of IT. We do IT with our customers to help them be better. Innovation or efficiency, both are good.
How is the relation for your cloud business? You mentioned hybrid cloud and explained why you are not just a reseller of the public cloud space, obviously. But we see that the public cloud companies in the US, the Microsoft, Amazon, Google, etc., they see a slowdown in cloud revenues now, which is probably coming from the public cloud market. And are you being affected by that to any mean, or?
Not really. So our value proposition on the public cloud is not reselling licenses. We do a lot more on top of the public cloud. So I think the analogy here is that when we sell a piece of equipment, so our traditional historical business has been reselling of hardware and software, typically American vendors, and then we add value in terms of consulting, managing or operating the equipment, technical support. So our primary value add is not the reselling, it's the services we add on top. And obviously we look at the public cloud in the same way. Microsoft or Google or Amazon provide let's say, a general purpose platform, and then we help the customers get value out of it by adding services on top of it, managing it for them, making sure this whole multi-cloud environment works, so data is flowing efficiently, it's secure, the users can get access to it. So our value add is not the reselling, it's our services on top, and there's plenty to do there, even if their sales growth is coming down. They have increased pricing, and if you read external analysts, a lot of people expect that license costs for public cloud will increase by 30% next year. Obviously, that's something that may even have our customers come back to us a little bit and say, hey, can you guys do this more efficient? Public cloud is not the cheapest way of doing things. Some people may think, but it isn't. It may provide you very high, modern, highly innovative technology, but it's not always the cheapest. And customers are then trying to balance price performance will have to think hard.
I see. Then regarding the consulting business, do you think you will be able to mitigate potential salary inflation next year with price increases for that services on a standalone basis?
That's definitely our ambition, and we've been working on that since beginning of the year. We saw the risk of inflation already in the beginning of the year, and obviously the actual inflations here during the middle and second half of the year. So we've been working on increasing hourly rates for our consultants. All our reselling business, all price increases are flowing through. So we take quite a little hit of that. And then all our contracted business, we've been upping the pricing on throughout the year, both new contracts as well as existing contracts. So I think we've been proactive, and we've been trying to mitigate inflation as much as we can. There are contracts that are less easy to change, but I think we should be in good shape.
Yeah. When we look at the customer base for Proact, how is the split between public customers and private customers, and how do you expect them to develop in next year? I guess that the public side is going to be more stable, where you can raise prices due to the contracts, CPI-linked price increases, while private sector may be a little bit more difficult to negotiate with. Or
it goes both ways, unfortunately. Yeah. But I think our public sector is roughly a quarter of our business. It goes a little bit up and down, and it's usually stable. And maybe in times of decline and recession, public sector is investing, which could be good. We see contract-wise public sector sometimes more tough on the index-regulated contracts, and sometimes more open. I don't think you're going to see necessarily a segment-based opportunity there. It's going to be other things that drive whether we can manage price increases or not.
Okay. Will you be helped by contractual price increases from kind of 1st of January 2023, which is quite common in the industry here, with the public sector, for example? Would that help you get some growth next year, basically? Or?
I mean, I think part of the growth will be inflation-driven, for sure. Yeah. Absolutely. And then there will be volume growth as well. So I think from that regard, from a pure top-line perspective, the inflation is helping us. But we also need to manage our costs, of course, to have it flow all the way down to bottom line.
Yeah. And
I think January 1st is a magic date from that regard, if that's what you're asking. No.
And in terms of acquisitions, you mentioned the 5 latest here. It has been 1 or 2 every year. Is that what we should expect in the future as well from Proact?
I think that's a good pace for us. The way we do acquisitions is that we're quite picky. We want them to have a very clear value proposition that fits our portfolio, and we integrate them into our operations. So there's a lot of work in our due diligence process around culture and just pure company fit. And that also means that the integration actually takes time and effort. So we can manage roughly 2 acquisitions and integrations per year, and particularly if we rotate them around our regions. So we're quite decentralized in operations. And now Germany have their work cut out for them, 2 acquisitions in 6 months. But it's been quite some time since we did anything in the UK, Netherlands, and Nordics. So plenty of opportunity there.
And regarding the type of companies you're trying to acquire, historically, before you came to the company, Proact tried to acquire hardware resellers and transform them into service businesses, while now the strategy seems more to buy consulting or service-oriented businesses and then add some hardware reselling on it. Is that the way forward as well in your view? Or?
It is. I mean, clearly the service opportunity is much bigger for us, and the market of services is growing 10% per year at least, whereas the traditional reselling business is maybe a few percent, partly then driven by inflation, as mentioned. So the opportunity is bigger on the services side. So we're going to look for companies that are really good in the area of Microsoft Public Cloud. We're going to look for companies that are good in security, possibly networking. It'll be a mix of consulting skills or cloud services offerings.
Yeah.
That's where we're going to be focusing on.
Yeah. Then the final question on the margin target. You have a target to reach 8% EBITDA margin. You haven't been there for many, many years, so it seems to be an opportunistic target. What is really the key drivers to get you there in a few years' time?
I think we were hit negatively by the pandemic, so maybe the time schedule is a little bit further out than it should have been otherwise. But there are 2 easy things to say, not as easy thing to do necessarily. Scale is one of them, so continue grow our services business. And here I think we're doing quite well now, in particular this year. And then we have our own internal efficiencies. We still have work to standardize our service delivery and increase the level of automation and therefore become more efficient. But we should be able, if the world is somewhat stable going forward, which of course it's not showing any trends of that yet, but if it's somewhat stable going forward, we should be able to become more and more efficient over year by year.
And how important is acquisitions to reach the target? Is it necessary, or can you get there without future acquisitions?
It'll help us get there quicker, but I don't think it's necessary. But obviously, it drives scale quicker. It's a way to accelerate what we anyway do.
Excellent. That was it from our side. Thank you very much, Jonas, and presenting Proact.
Thank you very much. Thanks.
Welcome back, everyone. My name is Henrik Hintze, and I'm a capital goods analyst here at ABG. With me today, I have Jonas Inga, CEO of Gapwaves. Welcome, Jonas.
Thank you. Thank you, Henrik. First and foremost, thank you for inviting Gapwaves and me to have the opportunity to talk about Gapwaves. I'll give you an overview of the company and the technology, but also the application areas that are of most interest to us right now. And I'm relatively new in the company as CEO since late August, but I have been engaged with the company for almost 4 years now as its chairman of the board. So it doesn't want to work. I'll try this one instead. Okay, so within the market space that we're active, it's primarily driving automation. And when saying driving automation, don't think just about personal cars, the ones that you drive to work or to the shop every day, but also other moving vehicles. And I'll explain this a bit more later in the presentation. Gapwaves can also contribute in other areas, such as smart cities. In smart cities, which is a very wide nomination or description, there's a need for sensors, radar sensors that can detect or measure traffic or presence of humans to regulate, for instance, energy consumption or lighting in a city environment. And then, of course, connectivity and telecom and satellite communication. That's also an area where Gapwaves' unique antenna technology can contribute. And I'll touch briefly on these areas, but focus mostly on the area of driving automation in this presentation. In driving automation, radar technology is being used to help the driver. Of course, to create a better car, but primarily to help the driver. So today it's about driver assistance systems. We're not there yet with automatic vehicles that you just step into and the car drives itself from start to stop. But in driver assistance, these technology can help the driver to be a better driver. It's not taking over the role of the driver. For instance, detecting dangerous situations or doing emergency braking or helping when you change lanes. All of these technologies, I think most of you have experience in the cars that you have today. But there's a bigger underlying reason for this development, and here's one example in safety. And these numbers, 600,000 deaths, more than 600,000 deaths per year from people that are not drivers. They are on the side of the road or nearby the road, and they are unprotected. But these systems can help the driver react much faster and in a better way to avoid these. And for the society, of course, this is a big cost and a big improvement that can be had. So don't just think about drivers and regular cars when I talk about this. It's also about the other stakeholders that are nearby the traffic. So the safety aspect is one, but we also have other things that are talking or driving the marketplace for Gapwaves. It's regulatory, legal, and technical. For instance, in the technical aspect, frequency bands are being allocated, and you're not allowed to use other frequencies, so you don't have unwanted traffic in certain frequency ranges. And there's been a shift from lower frequencies to higher frequencies in automotive radar. So now they can only use what we call the 77 gigahertz band. And this is very important because Gapwaves technology performs better and delivers better performance at higher frequencies. And now the automotive industry cannot use the lower frequencies anymore. In terms of safety rating, Euro NCAP is one example. There's others also. It's not possible for a car manufacturer to get the highest safety ratings of cars without these driver assistance systems anymore. As a legal example, AEB, automatic emergency braking, that's a requirement in the EU market and now also in the US, that all cars that are being sold have to have these systems. And they are based on sensors and radar sensors. Not only radar sensors, but there's also other sensors, which I will explain. And I want to highlight this because these are fundamental market drivers in this field that creates a very good situation for Gapwaves and the application of our technology. So in automotive, of course, we have end users. That's us, buyers and users of cars. We want better vehicles that can help more in difficult situations. And of course, ultimately, I guess we want a better lifestyle. We have to commute to work at least a few days a week. And obviously, if there's like in Gothenburg this morning, we had snow, a few centimeters only. But still, it took an hour to get to the office instead of the normal 30 minutes. And it was due to a queue. These technologies, the driver assistance systems, can help you to will allow you to focus on other things while you're in a traffic jam or traffic queue, for instance. I'm sure some of you have already tried that in your current cars. The industry that supply the car manufacturers with these radar sensors and systems, obviously they need better performance for these sensors. The sensors need to be able to look longer, to see more in detail, and also be very compact in size because they need to be fit into the car, like inside the bumper. There needs to be a number of them, and the space constraint is quite significant. And of course, being automotive, it's always about cost, because they need a number of these sensors and there's a lot of other things needed in the car. And the car manufacturer really dictates the pricing of the car. So there's always a very strong cost pressure. And Gapwaves can deliver in these areas with our unique and patented technology. As one example, Volvo EX90, I'm sure you've seen some of it on the news. If you look more in depth into it, it's being positioned as a new type of safety level for cars and a new driver experience, state of the art, launched just a few weeks ago. And the EX90 has a number of sensors. It has one LiDAR, which is a very advanced camera type of sensor. It has 5 radar sensors in it, and 8 cameras and 16 ultrasonic sensors. And each radar, because that's where we're active, needs each an antenna. So that's 5 Gapwaves and antennas if the manufacturer is using a system from that is based on our antenna technology. And as the market moves to more and more automation in the vehicles, more and more sensors are needed. I've highlighted a number of radars. Currently, I would say that the industry is at level 2. So on average, per car, 3 to 5 radar sensors. That's 3 to 5 antennas. And currently, there's probably 80 to 90 million cars being produced in the world annually. And obviously, it's a lot of radar sensors that are being put into cars already. But as the field moves forward, or to the right here in the picture, towards higher levels of automation, the number of sensors needed increase. So I would say that the Volvo EX90, which I showed in the previous slide, is probably at level 3. It has the hardware to allow for level 3, which means that under certain conditions, like on a freeway, below a certain speed, you're allowed to let go of the steering wheel and not look at the road. You can bring up your tablet or phone or do messages or emails, etc., under certain conditions. It also requires that the authorities approve of this. But in Germany, they have approved this on the freeways. And there is a car from Mercedes that has this capability also. But the entire field is moving in this direction. So it's a huge growth area for us at Gapwaves because the need for radar sensors is growing. And it's growing quite quickly. 27% a year from current around 50 million radar sensors going into cars, growing at close to 30% per year, up to 240 million expected in 2027. So, and of course, this is a very promising growth area for Gapwaves. And on the right, you see some of the companies that supply these systems, and some of them we've been able to communicate as our customers also. So our solution, and why is it key? Well, a radar will not work out without an antenna. Every radar sensor requires an antenna. And that's why the antenna and the performance of the antenna is really key in this development. When Gapwaves was started 2011, obviously there was a lot of discussions around 5G and telecom. And that is still an opportunity to be had. But the industry, the telecom industry, they've been able to launch 5G and to handle the required bandwidth and the amount of connected devices without changing their frequency bands. So they've been able to upgrade the existing networks. However, in the future, they will have to utilize higher frequency bands. And when they do, they will need new antenna technology. So for Gapwaves, it's still a future opportunity for us, which is quite significant. But it all comes down to the frequency bands. If they are not using frequency bands at 30 gigahertz or higher, we don't really add that much of a benefit compared to the current antenna technology. And of course, you've already seen the news of 6G and even higher frequency areas, which is obviously another potential opportunity for Gapwaves. On the right, you see some of these antenna examples. The top right picture shows a corner radar. There's 4 to 5 in each car. Under the bumper, typically, and one in the front, the grille of the car. On the lower right, it's a higher resolution type of radar. It's 10 by 10 centimeters in size. Typically, it's placed in the front of the car. It can look much further ahead with much greater detail. And with our technology, we can build these antennas in 3D construction or 3D layers. So they can be very easy to assemble. We're using cheap materials, plastics with a metal coating, and obviously they are very easy to assemble. All of these factors are very important for the automotive industry because it keeps the cost down, so it can easily be scaled up in huge production volumes. Inside the antenna, we have a patented way, that's the invention really, where there is like a magnetic field that guides the signal through the antenna. And like I mentioned, we have a number of patents around this. In a business perspective, we have the tier ones. That's the big suppliers to the automotive industry. OEMs, that's the producers of the cars. But on the lower part, you can see the Gapwave business. Typically, we're being approached by the radar suppliers to the car industry. And they have a set of performance specifications that need to be met. We develop this antenna prototypes for them. We typically get paid to do that. And then obviously if the antenna performs, they sign a contract with us either for licensing or for us to supply that to the manufacturers. They supply the car manufacturer who launched the car into the market. And then typically it's a pretty long cycle. A car has maybe a lifespan of 6 to 10, or in some cases even more than 10 years. But during that period, the system is not being changed. You don't change the components in an existing car. So obviously there's a big aftermarket for the supplier, and then it starts over with a new radar generation, new car generation, etc. So it's a very strong business once you get into it with your products. We have licensed our technology to some of the leading car suppliers, Veoneer in 2019. That's a license agreement. Hella, and nowadays it's called Forvia, or part of Forvia, in 2021. Also a license agreement. However, We use a production partner of Gapwaves to produce these. So we are also active in the production of the antennas, which is a difference versus Veoneer. And Smart Micro is actually a smart city type of radar sensor, so it's being used to monitor traffic. And this summer we were able to announce a partnership with Bosch, where we developed a very high resolution radar. It's called imaging radar, so it will provide the same relevant information as a camera will do, but not all the unnecessary information that the camera provides. And with Bosch, we're developing a new type of radar sensor. We developed the antenna part of that. And then we're also nominated as the supplier for Bosch in very high volumes during a number of years to come once they launch the product. And when we talk about production, it doesn't mean that organically we have to produce millions of antenna in our facility. However, we have production capability today of maybe 100 to 150,000 antennas a year in our facility. But we work with different partners, and we can use partners to produce antennas in larger volumes. But we want to be the supplier. We want to have the relationship with the car industry and negotiate the contracts and pricing, and not just be a license provider and technology provider. We see other opportunities. I mentioned it in the beginning of the presentation that there's other segments in the market, for instance, smart cities, but also in terms of vehicles. There's trucks, there's autonomous trucks, there's loading trucks in harbors, there's airport vehicles. All of these vehicles, to automate them, they need to have perception of their surroundings, and that requires radar systems. So we have other segments that are not as big in volume, but have very interesting price points for these systems. Just wanted to show a quick illustration of one of our production units in our facility. This is a testing robot. It cycles through one antenna every 5 seconds. So we have quite a bit of capacity. This is a product that we have developed, and we sell also these equipments to our production partners. So briefly, Gapwaves, I mentioned that already, founded in 2011 by a professor at Chalmers University in Gothenburg, Technical University in Gothenburg. And we were listed on Nasdaq First North in 2016. We have become a standard solution for these types of waveguide antennas that we're involved with. And we've already been able to communicate 3 of these major partnerships with leading car industry suppliers. We have a good patent situation with close to 40 patents on our technology, and we're also exploring patenting the production of the antennas, and also the testing and calibration of the antennas. So it's not only around the technical innovation as such. And obviously, as I mentioned, we have a technology that is very well suited for high volume manufacturing. So it's really geared well for the car industry. And just to finish off here, those of you who have followed Gapwaves through the years have seen pretty interesting development in the last few years, with significant growth and stepwise, of course, but this is also related to the contracts that we've entered. Like I mentioned, this summer, a major agreement with Bosch, and of course that is in development phase right now, but will come into a delivery phase in a few years' time. But also this year we've seen strong development. So just the first three quarters we're already at 53 million and 105% growth versus last year same period. And Q3 was also the first profitable quarter for Gapwaves, which is a milestone, 6.3 million in EBITDA. And for those of you who follow us, you know that we have a strong cash position, 178 million right now. So it looks very positive right now. But the sales, the cycles in the automotive industry are strong. But once you're in there with your products, you can be relatively secured in a long-term supplier situation and to be able to supply products during many years. Yes, that was the short overview and update on Gapwaves. Thank you.
Thank you very much for that, Jonas. Let's move on to some questions. So, speaking of your technology, what technologies do your competitors use and how do they differ from yours?
We are involved with what is called waveguide antennas. So think of it like a metal box which guides the signal. We have a special version, as I mentioned in the presentation, of the waveguide where the metal walls are not being used. Instead, we create a magnetic field that guides the signal in the tube. So we're not so reliant on having a perfect metal tube, which means relaxed or not so hard mechanical requirements when you assemble it. We can make it thinner, and we can also use cheaper material than the competitors. So there's different type of competitors. One is traditional antennas, and they have too much losses in higher frequencies, so they cannot perform on the same level. But we also distinguish ourselves versus other manufacturer of waveguide antennas, these metal tubes, because we're not using the metal tube as such. We create a magnetic tube instead, and that's the invention by the professor from which the company was started. And I say it again that our method allows easier and more cost-effective production. So because it doesn't need to be that precise.
Interesting. At the beginning of the presentation, you mentioned this frequency regulation change, which kind of cemented the need for higher frequency antennas. Why was this change made, and could there be additional changes in the future which puts your technology to its limits?
Not in terms of higher frequencies. I think we're very far away from having technical limitations on high frequencies using waveguide technology. I guess the main reason for assigning new frequency bands is that it becomes too crowded in the existing ones. As you bring in more devices or more connectivity, etc., then you need more bandwidth. And higher frequencies can also transmit more data than lower frequencies. So it works the same as the telecom industry. But it's very strict that you're not allowed, you will not get your products approved unless you stick to the assigned frequency bands. So it's a very hard technical requirement.
All right. You mentioned the 5G market as a potential future additional market beyond automotive. Do you see any other markets which could become relevant in the future?
Other than 5G?
And the automotive, which you talked about.
Yeah, I mentioned also smart cities. And if we move outside of traditional automotive, there's everything else that moves. It doesn't even have to be on the road. It can be flying on top of the road. All of these things need to perceive the surroundings. I mean, there's sidewalks, there's crossings, there's light poles, etc. And even if it's just a stupid delivery box, which is automatic, it still needs to perceive these things, otherwise it will bump into them. So all of these areas are interesting when it comes to radar sensors. Compact and cost-effective radar sensors. And they need an antenna technology to go with it.
All right. Finally, where do you see the company in 5 years, and what are the biggest challenges in getting there?
I think in 5 years, with the current agreements that we will have Gapwaves antennas in cars and other things moving around in our society. And Gapwave will be a large-scale supplier to automotive industry. I'm pretty sure that we'll have some more things moving on the telecom side as well. But also these other things that will move around in society. I'm sure you all follow what Einride and other players in the US and China are doing with robotaxis and automated transports and people transports, etc. I'm pretty sure we'll see applications and Gapwaves in those areas also.
Thank you very much for that, Jonas. That's all we have time for. And thank you all for listening.
Thank you.
Hi and welcome to ABG Sundal Collier's Investor Days. My name is Hanna Forsgren and I work as an equity research analyst. Here with me today I have Johan Arvidsson, CEO for Nexam Chemical. The stage is yours.
Thank you very much and welcome to some Christmas entertainment from Nexam Chemical. We are going quite quickly into the end of the year and I'm happy to be here. I'm happy for the cooperation we have with ABG. We have been doing that for almost a year now and it has been a great experience. I'm going to tell you about Nexam Chemical and I'm the CEO of Nexam Chemical and I've been the CEO for almost 4 years now. Nexam Chemical. We are making additives for plastic and we both develop it, we produce it and we sell the additives to the plastic industry. And it's kind of easy to come to the conclusion working with plastic or dealing with plastic that plastic should never have been invented. It's not a part of a sustainable society. On the other hand, it's such an integrated part of everything we do, everything we have around us. It's perhaps not as much a question about if, it's more about how we are going to deal with plastic in the future. On the pictures, you see some examples of where it's more or less 100% plastic, what you wear while doing sports. It's an integrated part of electrification and renewable energy. It's in every handheld device and also healthcare. And I intentionally kept out everything you see when you go into the grocery store. So Nexam has additives that can change the properties of plastic. It can improve the properties and enable a more lightweight design, and it can also open up and increase the possibility to recycle the plastic. So we like to say that we are a part of the solution, not the problem. We simply make plastic better. Having that said, we obviously have a bit of a sustainability message from our company, and we wanted to develop our message in a certain way. We wanted to have something that is possible to audit and a program and to declare it not just that it's a fantastic thing and it do good for nature or something like that. We wanted a very crisp and accurate system, something. And we found such a system. We found it with Nasdaq, and Nasdaq have a program called Nasdaq Green Equity Designation. And we got through the program, and you can read the report. It tells quite a lot about how we are working with sustainability and our ambition to sell our products into sustainable applications more and more. So we try, sustainability for us is very much centered on the products we make and what good the products can make. The company, oops, sorry for that, I went the wrong direction. The company, we have 2 business units. The Nexam Performance Chemical, that is the more innovative part of the company. It's where we make the patents and we do the most of the recycling business. We also have a business called Nexam Performance Master Batch. The Performance Master Batch is more broad, more industrial, and it's very much centered around color master batch. The 2 units are equally important to us. One enables us to go broadly in the market. We have 400 customers in the Performance Master Batch. The other one is much more targeted, where we try to discover niches. So the Performance Master Batch help us to participate broadly, and that enable us to find the niches. So it's a great combination, actually. And you can see that also from if we compare the size of the businesses over the last. This is just taken from the last quarterly report, the quarter 3. and it's comparison between the last 3 years, Q3. So we have growth year on year, and you see they both develop. We focus to make sure that we can develop both units and have a nice business in both areas. If we zoom out a little bit and look to what has happened in Nexam over the last couple of years. And since 2000, we made an acquisition in 2018. We bought actually a color master batch company, and that's why we have that unit we needed the capacity and the capability of such a company. And that was done in 2017. 2018 is the first year where you can really compare the companies. And from 2018 to 2021, we doubled the revenue. And that's actually the target we have. And we did this completely organically. So it's no acquisition. It's selling more simply. And that's an ambition we have. And I copied this also from Q3 this year, and this shows that it's a little bit tougher this year. It started with quite a bit of logistical, how shall I put it, logistical difficulties to get raw materials, and both for us and also for our customers. And it has been a little bit slowed down in the economy towards the end of the year. So this year has definitely been quite tough, actually. Also, if you look to some of the applications where you believe that actually everything supports that those areas should grow, but it's still slightly slower, I would say. One thing I wanted to highlight, and we did that also in the quarterly report, is the cash. We have had a slightly, it looks like we are deteriorating our cash position very quickly. That was an effect of we stopped production to a large extent during September. We installed a new production line, so we produced a lot up front, and then we had to supply our customers for a bit of time. And that hit us during this period. So that's a comment we make. It should look better in the next one, the Q4 report. That's pretty much the message here. Otherwise, you can have a look on the figures in our quarterly report. I actually encourage you to go in and look at it if you're interested in our company. It's a live stream of the quarter report presentation. So, the following slides, I'm going to tell you a little bit more about what we are doing and where we can see great opportunities. We are lucky enough to really be connected to some of the mega trends. And one of them in the beginning, and I will deep dive into two of them in the coming slides. But just to start, the first one, we were very much into high temperature composite material, lightweighting of plastic materials that can be used at very high temperatures, up to 300 degrees Celsius for a long time, that fits perfectly into aircraft engines. And this is really where we learn the chemistry. And so it's easy to say that we are a little bit fragmented. And in one way, we are working with very many different applications, but it's actually the chemistry that brings it together. We do pretty much the same thing. Reactive chemistry for polymers. That's what we do in pretty much all of these areas. The two areas I would like to highlight a little bit and explain a bit more in detail is what we do in renewable energy, and also our ambitions in the recycling industry. We you see the image of the windmill here, and we are not producing windmills. We are also not producing the blades to the windmills, but the core materials in all the windmills are built on a foam. It can be different type of foam, and we are selling additives for PET foam. And PET foam is the kind of winning material in that area. So we are directly connected to the windmill industry. If they're building a lot, we are selling a lot. But I will go a little bit deeper into that. The first thing I wanted to show, and I actually have two of these. It's taken from two different sources. We are growing with the wind energy industry. They are installing more and more. It doesn't go as fast as you might believe from looking at the need for electricity, but it's like 2% on an annual basis for the coming couple of years. And actually, if you look to a little bit longer, if you look into the expectation for 2030, it's going to be produced 1 million blades. That's a high number. And if you want a reference, if you put the blades next to each other, it's 1.5 turn around the Earth. So it's quite a few. And if we're looking, here is exactly the same thing. It's from another one. The former one was the Global Wind Energy Council, and this is the Wood Mackenzie report. And it shows pretty much the same. It's a growth of like 2% in the coming years, 2-3%. No, sorry. It has a growth rate of 6% in the longer range up to 2026. So it's a continuous growth in that. So we have the support from the industry. The other thing is that PET is not the only core material that can be used. You can use other things, but PET foam is the one that is winning in the industry. So the blue line, and this is also from Wood Mackenzie, the blue line is the share of PET as core materials in the windmill blades. There is also the PVC, and you have actually also balsa. It's the wood balsa that is used. Those are losing in share, and PET is winning in share. So on top of the general industrial growth, you also have a winning material. And Nexam, we also have the possibility to grow with customers. We are not selling to all foam producers, but I would say we have projects with all of them. We are heavily into 2 of the 4 major windmill producers, and we are definitely aggressive on the other ones. That was about wind industry and PET foam. The other one I wanted to tell you a little bit more about is recycling. I think this is perhaps the most interesting thing for Nexam in the coming, let's say, 5 years or something like that. It's very easy to have the image that plastic recycling is a problem that we solve. I've been carrying plastics to the recycling container for the last 10 years. But if we look to how much plastic is actually recycled, and then it's a little bit more depressing actually. It's on a global basis 15%. The rest is landfill, waste, incineration, but around 15% is recycled. The EU target for 2025 is 50%. And here is the big question: how do you get from 15%? EU might be a little bit better, by the way. They might be at 18. So, but they're definitely not on 20% recycling. And they're going to bring that to 50. It's obviously not going to happen. They will not hit this target. But they're moving in that direction, so it will be a growing business and a business that is looking for solutions. And from an EU perspective, they are starting to use the tax tool. They put tax on non-recycled plastic more and more in different countries. It's always a little bit delayed and so on, but it's absolutely moving in one direction, and we will see more of this. And the more we manage to develop technology, sorry for this, that actually can enable the recycling, the higher the pressure will be. So what do we do in recycling? If you are melting a metal, you can melt it, and when it freezes, it's this kind of the same metal again. And you can do this over and over and over again. With plastic, it doesn't work like that, and that's why it's a little bit difficult to recycle it, because the properties of the material is getting worse and worse every time you recycle it. So you lose properties from every turn. You need to compensate for that, otherwise you cannot use it more than once. And one compensation is that you mix in new plastic, and that's kind of, it's a help, but it's not the final solution. You actually need to address the chemical and treat the plastic as a material and work with its chemistry. You can do that, and the perfect, and here you have a little bit different type of concepts. Sometimes you want to do the same thing over and over again. The bottle to bottle is a typical example of that. Then you need like this system where you pay for the bottle and then you get money back when you leave it, and then you can keep it quite tight, and you build a plant that can improve the material properties at every turn. Very often it's not that sophisticated. Very often it's just collected, and it will actually you melt the plastic and make something new. That's a typical example of downcycling. And this is actually where we are really trying to make a difference. We try to move the angle of this arrow a little bit upwards versus upcycling, that you can actually improve the properties of the materials that enable you to not only make like garbage bags, but perhaps sporting shoes or something else, products with higher value. And going from 15% up to 50%, with the 15%, the first one, we managed to do all these garbage bags and flower pots and things like that. If we're going to use the other volume from 15 up to 50 or ultimately 100, we need to be a little bit more creative, and that's where we have our opportunities. We sell additives that actually can change the structure of the plastic and enable recycling on a different level. And to explain a little bit in the back what has been happening, we have a system we call reactive recycling. It's actually a brand. It's a lot of products that we pack inside that brand. We launched it in 2021. And we clearly see that this plastic recycling, it's really growing now. It's happening now. There was a big trade show, and all companies in the plastic industry, if they don't have a recycling story, they don't even bother to go to the trade show. Everyone sends out the same message. But it's surprisingly how few that actually address the chemistry of the plastic. It's a bit around how you mix it with virgin materials and perhaps a little bit of stabilizers or shredding machines or a lot of in machinery. But addressing the chemicals, not so many. Nexam really sticks out here. We are one of the few. And just to give you a reference, we have more than 50 recycling prospects that are testing our products, and half of them are beyond the kind of send a sample and see what happens. they actually go into more of industrial trials. So we are super positive about this. It will not go as fast as we want to, but I see this as our most interesting opportunity. So I'm getting to the end of this. What's good about Nexam beyond the things I've already told you? You might have understood from the presentation that when we manage to sell something to a customer, we are really an integrated part of the customer's innovation. It's not like something that just, it's not an accessory or something like that. We will be a part of the customer's chemical backbone often. So we will stick to the customer for a long period. It sometimes takes 3 years to gain a customer, but it definitely takes more than 3 years to lose them. Circularity is another reason for choosing Nexam. We definitely have a plan for it, and we are super positive around that plan will be possible to improve, and it will help us and support our business for many years. And my assessment of our company is that we are really in the beginning of our journey. Some of you have been investing in Nexam and been quite patient over many years, but I truly believe we are just in the beginning of the journey. With that, I'm actually ending the presentation. There is, for those that haven't seen it, there is a bit of a small film you can see on our website. It has been there for some time, but it explains what we're doing. Thank you very much.
Thank you very much, Johan, for the presentation. So if we look at the numbers for performance chemicals year to date, you're below compared to last year.
Yes.
Could you tell us a bit why is that?
Yeah, it's actually not the numbers never lie, but it's explainable. We have our biggest customer have had a bit of difficulties to hit the same level of business this year as last year, so we lost quite a bit of turnover with our it's not our biggest customer anymore, but so it's quite explainable on a very limited part of our business. It's pretty much one customer that explain the deterioration of our turnover for the year. So if you take away that customer, it looks quite positive actually. We have a solid growth in everything else we do.
All right. So my last question will be, what could be potential sales driver for reactive recycling?
Drivers for reactive recycling. It's actually the reactive recycling has been a garbage industry, we can say, and a little bit of the opportunities there is also this, at the same time the problem. The opportunity is that there are not so many working with these things, and that's so it's an addressing really the properties of the material. The problem with that is that the people you meet in this area, they are not really considering themselves as a chemical industry. They have been collecting garbage and trying to get rid of it. And we want them to start a chemical business and actually increase the value of their material. And this takes a little bit of time, but it's also the biggest opportunity here. So yeah.
Thank you very much, Johan.
Okay, thank you very much. Merry Christmas.
Hi everyone, and welcome back to ABG's Investor Days. My name is Carl Bokvist, and I'm an equity analyst at ABG. With us now we have Bergman & Beving and CEO Magnus Söderlind, and we will first of all hear a presentation, follow up by some Q&A. So without further ado, Magnus, thank you for joining us, and please, the floor is yours.
Thank you for being here. So let's start. What is Bergman & Beving about? And this was the headline of the leading Swedish business newspaper, Dagens Industri, last year. And then labeled us as the ancestor of stock market rockets. So that's quite a bold statement, and I will come back later on why they chosen to have this headline on Bergman & Beving. But first, what are we doing? So we are actually, let's see now, we should change, So we are actually acquire and develop companies long term. As owner to 21 companies today, we have a long-term perspective on those companies. And we don't buy to sell, we buy to keep. And we don't have any exit horizon on the companies. So we take an industrial approach to the ownership. And we focus on acquiring and developing leading companies within expansive niches. So we have chosen to focus on niche companies and companies then having a leading position in those niches. And our kind of logic for that perspective is that if you're addressing a niche, it's not so big, so many companies want to invest in that niche. And if you then have a leading position in that niche, i.e. be number 1 or 2 in that niche, not so many are interested to outcompete you from that position. And if that niche also have an underlying growth, as a company you can have a good journey based on those market conditions. So that's very important if you look at our companies that they're actually addressing a niche and have a strong position in that niche. Since we are mainly based in the Nordics, or our companies is mainly based in Nordics, we have a focus on productivity, safety and sustainability. And what's a little bit special with the Nordic region compared with, for example, the rest of Europe is that labor cost is quite high in the industry and the construction sector. So the customers here are really interested in finding solutions that make them more productive. And also in terms of safety, the Nordic workplace safety, the Nordic region is typically in the front line in Europe and the Western world. So if you have products that addressing that in a good way, you have good export potential when the rest of the markets is maturing. And that's also in terms of productivity. So we can see if you have a strong position in Nordic with strong products, over time you get a good export potential in those aspects. So going back to the headline in Dagens Industri, first just to give a short history of our company. We actually have more than 100 years of running Bergman & Beving. It was founded back in 1906. And then in 1976 it was listed on the Swedish Stock Exchange. And then over time it was growing. And in the end of the 1990s it was more than 200 companies within Bergman & Beving Group. And the owners then decided to split it up into 3 separate listed companies. And those are still on the Swedish Stock Exchange. One is Lagercrantz and the other one is Addtech. That was then separately listed in 2001. And then over time, Addtech has listed a separate company called AddLife that also is on the Swedish Stock Exchange. And what then was remaining within Bergman & Beving was then called B&B Tools. And between 2001 and 2017, Bergman & Beving was consisting of product companies, wholesaling business, and reseller business. And the reseller business was under the label Tools. That is one of the leading brands in the Nordic region within reselling to the industrial and construction sector. And during that period, Bergman & Beving Tools, that was the company, was aiming for a one company approach, i.e. integrating all the way from the products business flow to the reseller. And that was kind of separate to the general DNA of Bergman & Beving, that always has been having a very decentralized approach and not talking about integrating things and having autonomical companies in the group. And over time, they didn't really get the synergies or the effect of this one company approach. So back in 2017, we spun off the reseller part, then called Tools, to build a new group called Momentum Group that was listed in 2017. That is now part of the Alligo Group, and they have also spun off a company called Momentum Industry. So as you can see, over the year of Bergman & Beving, we have created companies with a market cap of roughly 100 billion SEK. So if we then look at what happened then, after the spin-off of Momentum, we had some regrouping to do within the group. We have to strengthen our product companies and their product portfolio, and we lost actually a lot of business volume that was previously gone through the reseller part and the reseller business. But then, since 2020 again, we have built a very, very strong platform and are now have a profit expansion program with the aim of double the profit up until latest fiscal year 25-26, and that turns into 500 million SEK in profit in EBIT profit. And how should we then double our profit and get to the 500 million latest by fiscal year 25-26? We have today a current portfolio of 21 companies, and we see a good potential in increased profitability, earnings, and margins, and also to generate better cash flow in the companies that we own today. And as you can see on the latest quarter, we had a steady improvement, underlying organic improvement in our current portfolio companies. And if we look at all the companies have short and mid and long-term objectives, and we see a great potential in the development in those companies based on the targets we have on those. And we also have, since we have a very decentralized model, we have a company-by-company approach. And that means that we have individual strategies for all the different portfolio companies based on the potential and based on their current performance. Since all companies are operating separately, it's quite few interactions between the companies. But we as a group is supporting the companies in their company development. So we have built a B2B toolbox, that we say, that includes a lot of different tools that we can help the companies to develop in a positive way. And I will come back to that a little bit later on. If we look at new niches that we're interested in, and we're acquired into 2 new niches lately, I will come back to one of the latest acquisitions we made later on today. It's really about acquiring us into new niches. It's not about the current companies to grow into new niches. We really focus on getting establishment and leading position in new niches by acquiring new companies that already have a strong leading position in their niche they are addressing. And we have stepped up the acquisition path during the last fiscal year, and we aim to improve or increase that even further when the cash flow improves. And once again, we buy to keep, so it's not kind of buying to then sell. It's a long-term kind of commitment we have to the companies that we own. If we then look, we have 21 companies in the group today, and they are divided into 3 different divisions that kind of label on the focus area of our group today. So the first division is building material, and this is a company focused mainly on material used within the construction sector. And the second division is workplace safety, and that is then addressing safety issues within the industry and the construction industry. And then the third division is tools and consumables, that having different type of companies having tools and machinery and also consumables in their assortments. And most of those companies based in the Nordic region, even if we have companies in other countries as well. But the Nordic market represents 80% of our sales today. But our product companies, many of those have exports across the world. So we are representative by our companies in more than 25 countries across the world then. As I said earlier, we have a company-to-company approach based on what strategy we expect them to deliver on. And on this picture, you can see two axes. On the horizontal axis, we have a measurement we call profit of working capital. That's a profitability measurement. And we want all our companies to be at least at 45% profit of working capital. And on the vertical axis, we have the profit growth potential. So we look at our company and evaluate how competitive are they in their niche and what is the growth potential in the niche as such, the underlying market. So based on this model, we kind of plot all our companies. And if they are on the right angle, it's really about focusing on profit growth. And they can grow organically, or they can also grow by you're doing add-on acquisitions. And I will bring up some example on that later on. And then on the very left wing, you have red, and that is really, they are not profitable enough. They don't have the profit of working capital even below 25%. And then it's really about focusing on profitability. And it's not about, growing the top line. It's really to get the figures right first before you get into a growth path. And the higher you are on the vertical axis, the more we want them to grow, of course. So we as an owner actually plot all our portfolio companies in this matrix, and that is kind of then deciding what should be the focus that we drive in the board work that we have with our companies. I talked about the toolbox that we have, that we provide to the companies. You can see on the left-hand corner, we talk about direct injection of functional expertise. Many of our companies is around 100, 200, 300 million in turnover, and they don't have expert knowledge in all functional areas. So we have a network of experts, within pricing, within inventory optimization, within export, and so forth. And there we can help the companies driving project initiative to improve their business. We also have the best of two worlds, a small scale and on a large scale basis to the left. For example, we have a logistic company within the group that is then providing services for all the companies that want to have that service. It's kind of providing a big scale logistic operations for many of our smaller companies that make them cost effective. So we have some of those type of functions across the group that the company can use if they like. It's not a demand, but they can then get leverage on having a big scale operation, even if they are quite small as a company. Then we have support for internationalization. As we have subsidiaries in our group in many, many different countries, it's easy for one company to leverage already established daughter companies' infrastructure. We have, for example, a company owning a subsidiary in Benelux, and then just recently another company leveraged that office location, warehouse and so forth locally to get a very easy establishment in that geographical region. So that's also a way that we can support companies to go international in a more cost-effective way. Improve people development and motivation. We have what we call the Bergman & Beving University, where companies can send their employees to improve their skills, but also to leverage and get some relations and contacts across the group. So that's a very appreciated initiative we have. So as you can see, I will not go through all the things that we have in our toolbox, but we have the ambitions, and we also help the company in practice to kind of develop in a positive way and take some benefit of being part of the Bergman & Beving group. I mentioned the profit expansion program that we have since 2020. And this is development we have the last 2 years. It's a CARG, and this is the EBITDA development. And it's a CARG of over 20%. And the last quarter, we actually presented 84 million in profit. But on this slide, you see it says 94. And the reason is that one of our companies, Luna Group, their logistic provider had an IT attack. And so they were not able to deliver invoice in the last weeks of that quarter. So we estimate that had quite a big impact on the profit, about 10 million. So the underlying profit was 94 million. And I expect us to be back on this track, profit improvement track, as of this quarter. And the two other divisions, the building material and the workplace safety, had a profit increase of about 20% in this quarter. So the underlying business is having and following the profit expansion plan as we have set. I will just give you some example of the companies that we own for you to get a picture of what we are doing. So this is one company within the building material called SV. The company has a turnover of roughly 1 billion SEK, and have 155 employees, and have an average and profit margins slightly above average. And you can see on the pies here, it's kind of symbolize what type of improvement opportunity we see in those companies. And as you can see on this, the big improvement opportunity is in the margin. They are actually Nordic market leading within fastening, and we as a group have roughly 7% profit margin now. And that is roughly what they have, but I see a potential to have a double-digit figure in profit margin in this company in the future. And they have some very interesting products. They are really leading within fastening and fixing. And for example, this STEC Max is a screw that is used that have some very unique functionalities that is very appreciated within the professional market. We also own a patent called Nail Indoor that is improving, less waste, much more half the time of assembling, and much fewer material than a normal indoor has. So this is type of innovative product that increase productivity within the construction sector. Another example, this is the workplace safety. This is the Cresta Group. They are leading specialists in safety and height attitude products that you use when you're working in windmills, for example, or on high construction sites. And this is a company where you see have a profit margin well above the group level. And here it's not about improving the profit margin. This is really on the right part of this focus model. It's really about growing the profit, and here we see a great potential. And this company has actually made 4 add-on acquisitions during the last 2 years. So they have both an organic growth, but also acquisition-driven growth. And they are taking, a strong position now with those latest acquisition in the UK, but also has entered in the US by Abtech Safety and Safety Technology. So this is really a company with great growth opportunities and also have very good profits. To take some examples from the last division, tools and consumables, this is Teng Tools, and they are doing hand tools. We the focus on having outstanding storage solution for tools. This is really for professionals, and they typically have 1,000 tools, and they need to get them organized in a good way. So this is a company really having a strong position in that niche. So less than 1/3 of the revenue here is in the Nordics. So they have, for example, subsidiaries in Australia and UK and Ireland, and they also have business in the US. So this is really a global concept with a global presence. And this has also, as you can see on the slide, a profit margin well above the average, and also a sustainable top-line growth potential with this storage concept. And there are some very good, interesting things going on in this company currently. And lastly, as an example of companies that we own, this is the last acquisition we made. It's a Finnish company called Polar Term. And they are an international leader in powerful mobile heating units. And this is now very popular, unfortunately, I would say, given the oil and gas import kind of restriction that is currently taking place. So this is really very powerful mobile heating units used by engine by diesel, gas, or electricity. And the green one on this picture is actually sold to the US Army. So they have a lot of export in the US as well. And this is a company with a very, very good profit margin, but also with a good profit increase potential. So in summary, we have been working with the business that we are running for more than 100 years, with a proven track record of creating shareholder value of 100 billion SEK. And we have a profit expansion program to double the profit, latest fiscal year 25-26. That's 500 million in profit, which we are on track currently. And the whole company, including myself, is very committed to this plan. And many of us have a lot of skin in the game as well. So I feel very confident that we will be able to deliver on the plan we have set.
Thank you, Magnus. The first question on the growth target and the potential for acquisitions. Do you see any particular area where you see the strongest opportunities or the most opportunities, either be it divisions or countries?
If we look at the two latest platform acquisition we made, they are Finnish companies. And one of the reasons is for that we felt that the multiples in many other countries was kind of escalating. So we felt that we could have good value acquisition in the Finnish market lately. But I kind of see now indication that the multiples is going down in many countries currently, and much fewer buyer nows out in the market.
And then the core of the Bergman & Beving culture about decentralization. How do you balance the autonomy, decentralization with you actually injecting these perhaps focus points in what you suggest the company should do to improve profitability, for example?
I mean, in our decentralized model, the management team always develop the strategies. And they kind of set initial targets. But then, since we are part of all the company boards, we then have a discussion if we think as an owner that the priorities is correct, and also that the target is ambitious enough. But all our companies are aware of this focus model with the two axes, and they know what they could expect from us as an owner in terms of priorities. So I think it's a good balance by we as an owner make sure that we are in line in terms of priorities.
Then we, at least here in Sweden or in the Nordics, we do see some indication of new construction slowing down. Bergman & Beving has a long history of seeing perhaps downturns in the past. I think during the financial crisis you declined something like 20% organically of what it looked like then. But have you seen any weakness as of yet? And how do you prepare your businesses for a potential downturn in mainly new construction?
First, I want to say 60% of our revenue is related to industry. And then less than 40% is to the construction sector. And then if you look at the construction sector, they are mainly affected of a number of employees working in the construction sector because it's mainly consumables. It's not investment product. So now you can read about the downturn in new building, for example. But that doesn't affect our companies, at least not in the next 1 to 2 years. Because the number of employees is still going up in the construction sector. So as a group level, we haven't seen so far any slowdown in the demands. But over time, maybe we get some effect, but that I expect coming later then.
And with that, I think our time is running up. Thank you, everyone who has been listening. This concludes our presentation.
Thank you. Thank you.
Hi and welcome to ABG Sundal Collier's Investor Day. My name is Hanna Forsgren and I work as an equity research analyst here at ABG. With me today I have Mårten Hellberg, CEO for OrganoClick. The stage is yours.
Thank you, Hanna. My name is Mårten Hellberg. I'm CEO and co-founder of OrganoClick. I'll give you a little introduction to who we are today and also a little bit about the current development and also looking into 2023, which we are looking forward to a lot right now. OrganoClick, our journey began 25 years ago when my scientific co-founders, Professor Havfrén and Professor Armando Cordova, started their research within biomimicry and natural chemistries at Stockholm University and the Swedish University of Agricultural Science. They already then realized that this would become a problem. But 25 years ago, there was not so many people that thought about plastics as a problem. But they realized this and started to look into how can we use cellulosic materials and bio-based raw materials to replace plastics and different type of synthetic chemicals. And since 25 years, our mission has been to replace plastics and different toxic chemicals with bio-based solutions. Biomimicry, what is that? Well, that is to mimic different natural processes. Like, why is a leaf becoming water repellent? Or what is it that makes a tree so strong? Or why does some trees burn less good than other trees? What are the molecules and different natural chemistries that is doing this? This is what our scientific co-founders have been doing research within since the last 25 years. And in 2006, we founded OrganoClick based on their fundamental research within this field. And when we met 16 years ago, they had developed what we call modification of cellulosic fibers. We can click on organic molecules to the cellulose in wood, paper, textiles, and non-woven materials. Our name is actually derived from two different chemistries, organocatalysis and click chemistry. And we're actually very proud now that organocatalysis was awarded the Nobel Prize last year in 2021, and click chemistry was awarded the Nobel Prize this year. So both are chemistries that we started to use in different applications 16 years ago has now been recognized as extremely important to turn away from fossil chemistry to more green chemistry. So this is certainly something we're proud of. Coming from 16 years, it took us nearly 6 years before we actually could launch the first product. So it was pure R&D the first 6 years. But in 2012, we launched our first application based on this chemistry. And today, 16 years later, we're working within 3 different fields where we utilize our core technology of modifying cellulose. And we work with wood impregnation or wood protection, where we replace different type of toxic biocides and heavy metals with natural minerals that we attach to the fibers. We work with binders. That is a way of increasing the strength of materials such as textiles, paper, and non-woven, where we are replacing synthetic or plastic-based binders in, for example, a napkin or a wipe with different biopolymers that we find in different side streams from the food industry, like an orange peel, for example. And we work with textile impregnation, where we are replacing PFAS or fluorocarbons, which is now being banned in the European Union, with different water-repellent molecules that you can find on leaves. So we're really targeting major areas where there are toxic chemicals today. Today, we have been listed on Nasdaq First North since 2015. We have our headquarter, our R&D and production in Täby, where we now have a production capacity of actually not 20,000, but now we see it's 25,000 tons, because our new production line is working better than we expected. We see that now that we'll get out an extra 5,000 tons from the new production line that we installed in September. So that is really nice, actually, that we can say that. Last year we had revenues of a little bit more than 100 million, and we can also now be proud to say that we were certified as a climate neutral company since October this year. And that is due to the fact that we are only using renewable energy in our production. We have transferred our car fleet to electric cars, and we use actually zero fossil energy in our production line. So this is really something that also our customers take notice of, because they also want to reduce their carbon footprint. This is a very clear goal for our industrial customers. We have our companies divided in 4 different business areas, and I will start with the business area which we call non-woven and technical textiles. And for you who does not know what a non-woven material is, it is something that is in between paper and textiles. You produce it with a machine which is similar to a paper machine, but you use soft fibers so you get a textile-like feeling on the material instead of a paper-like material. And what you see here on the right side is a napkin, a premium napkin made by our customer Duni, which are now changing their binders that they've used, which have been derived from plastics, to our binders, which is derived from biopolymers. So in these non-woven materials, they are normally composed of cellulosic fibers, which are renewable and biodegradable, but you normally impregnate them with plastic binders in order to create the strength in these materials. And here is what we have been working on to develop bio-based and biodegradable binders, where we're utilizing side streams from the food industry, biopolymers derived from, for example, orange peel, oat husk, wheat bran, shrimp shells, that mimics the same type of feeling and characteristics that the plastic binder gets. So you get a fully renewable and biodegradable material with our technology. And today, the 2 public customers that we have is Duni and Ahlström. One important aspect why the companies are choosing to work with us, except for the sustainability aspect, is also the European Union Single-Use Plastic Directive, which is targeting 2 product areas where non-wovens are used: wet wipes and hygiene products. And when we're talking about hygiene products, it's baby diapers, feminine care products, and this type of products. That they are composed of a lot of layers of non-woven material. This year is the first year when we start to deliver our binders to Duni. We have now until January to September 4.3 million in revenue, and most of this was generated in September when our first high volume deliveries started to go to Duni. So really now we are shipping tank trucks to Duni on a regular basis. So this Q4 will be the first one when we start to deliver really regular. So this is really exciting times for us. And if you go into the customer case with Duni, we signed a 5-year contract in 2021 with them with an approximate volume which is above 30 million SEK per year in revenues for us. This have now during 2021 and 2022 been scaled up, and the first high volume delivery started in September. So now in Q4 we now have a more regular flow of binders to them. We will not reach the complete volume, but we will nearly reach the complete volume of the agreement. But in the first quarter of 2023, then we will have reached the full volume of this contract. So this will then be a steady contract for us, supply of binder. The binder is an essential part of their production. So we need to supply them all the time. It will be like a tank truck every second day from our factory. So it's a quite interesting phase for us right now. If you look into other applications which we are working with agricultural nonwovens, where Ahlström have launched the first product group with our binders. We're working in several projects with hygiene products, so that is baby diapers, but mainly feminine care products. This is an area where we have a lot of interest right now. Wipes as well, this is a very important area. Tea bags is actually non-wovens, and coffee filters. And you don't realize that there is a lot of plastics in tea bags, but that is, and actually snus pouches. They are composed of about 50% plastic binders. So this is an area which is quite important for the Swedish market at least, and an area where we actually have projects ongoing to replace these plastic binders with our bio-based binders. In medical nonwovens, well, the mouth face mask. Probably many of you have seen a lot of face masks during the last 2 years being thrown away, and they are composed mainly of plastic polymers. There we're also involved in projects to replace them. So there are a lot of areas where nonwovens are used. But our main focus right now is, of course, the napkins, the Duni business, feminine hygiene care products, and wipes. These are areas where there is a lot of customer interest right now. Looking into 2023, yes, now we see that we will have the full volume of the Duni contract, so it will create at least 30 million in revenue for us. And we believe also that we will have a continuous growth to Ahlstrom. Ahlstrom is quite different to Duni. Duni is working mainly with napkins. It's like one big product group. Ahlstrom is a bigger company, but they have a lot of different niches. So we need to implement our binders in each different product category. So we have a lot of development projects ongoing with them, but we believe that with Ahlstrom we can grow for a very long time. And in the long term, there is bigger potential in the Ahlstrom business because they have 5 factories where they are using binders. They only have 1 factory, but we need to implement ourselves in their different products. It will be more like a continuous growth than a sudden big step in revenue increase. And 2 new customers are now preparing product launches in front of 2023. So sometimes, not first quarter, but I expect somewhere in the middle of 2023, we will have 2 new customers launching products as well. Within the functional wood area, we are working with wood protection that are free from biocides and heavy metals. We're using natural minerals instead. That is attached to the fibers and used as a physical protection instead of being a toxin to the wood fungus. Here we are partnering with Base Timber, who is performing all the wood impregnation in their factory down in Småland in Nybro. And the treated wood is sold in the Nordics, Germany, UK, Italy, and France at the moment. And here we have seen this year a very good revenue growth in actually Finland and Germany, while in Sweden the building market have really gone down. This is something that is an unfortunate part of the economic downturn right now. The DIY market and the building market is really going down for us. So in Sweden we have a weak market, but we have seen a very good growth in the German and Finnish market, and that is why we still have a slight increase in revenues as we are growing on the export markets. We have now launched 2 new wood protection technologies during the last year, and what we have really been improving here is the production, how we produce them. We get a much better quality, much more even impregnation. We get better durability on the wood, and this is now being implemented in full scale in our production, and this is now phasing out our first production technology. Here, what we see also is that we will reduce the production cost, and this is also a very important part in order to be more competitive towards the traditional pressure impregnated wood. But from 2023, we will have phased out the first generation completely and implemented the new production technologies. If we look at now what's happened recently, we see actually an improved sales development in Q4, which might seem a little bit odd due to the fact that the building industry is going down. But this is actually why. It's because Siberian larch, who have been a very big product in Germany and Finland, is now banned in these 2 countries. The import of that have stopped completely. So our distributors have started to buy in more organowood to fill up the gap that the Siberian larch, the export ban of Siberian larch have created. And Siberian larch have been a really big product in Germany and Finland. So oddly for us, this is actually supporting our business. In Sweden, it's not so big with Siberian larch, so here we don't see exactly the same effect, but in Finland and Germany, it is a really big product. So we expect this also to grow quite good in 2023 due to the import ban of Siberian larch. However, in Sweden, we believe it will be a weak market. Everything we see is talking for that. But in Germany and Finland, we think this will make up more than the weakness in Sweden, actually, in 2023. The new improved technology that we have are now being implemented in our production. It's a very easy production. We can use much quicker and easier way of producing it, even more even quality. So this will also improve our operations, or the cost in our operations. So this is something we look forward to now. In our consumer goods segments, where we are supplying consumers with our different chemical technologies. We have two different areas. We have one area targeting the outdoor and sport sector with textile and shoe care products, so textile impregnations in order to create water-repellent textiles. It's called Organotex. And we have one area targeting the DIY and building sector, BioClean, so it's treatment and maintenance of wood. Here we have two completely different markets at the moment. The DIY and building market is extremely weak. The consumers are, there we see a very, very sharp decline in consumer demand. However, on the other side, the textile impregnation sector, there we're growing really good. We have a 68% revenue increase during 2023 in Organotex sales, but it's still a smaller product segment compared with the DIY and building sector. So this, what in total, we have seen a decline for this business segment, although the Organotex product is growing extremely good. Organotex customers, we are selling it to retailers such as Naturkompaniet, XXL, Stadium, Team Sportia, Partioaita, the sister company of Naturkompaniet in Finland. We are now also targeting the German, the Dutch, Austrian market for Organotex, where we are. This is really the ambition for 2023 to go into these areas. And we launched also a very interesting collaboration with Snickers Workwear in October. Snickers is, as you know, one of the largest workwear companies in Europe. They want their customers to be able to re-impregnate their clothes. They sell a lot of clothes which is supposed to be rain or water repellent, but when you have washed out the water repellents, they have not had a product for them to re-impregnate them. But now they will start selling our product under as a co-branded product to all their retailers within the DIY sector. So it will be sold together with their clothes. And this does not compete at all with us because we are focusing totally on the outdoor and sport goods sector. This is where we are focusing with our brand. So this is what it looks like. It's Snickers by Organotex. And this is now being rolled out. They sell their products on 10 different markets. They have more than 1,000 retailers. So they are selling it now through their own sales channels, which is for us, of course, extremely good because we don't have any sales cost associated to this. This is rolled out by them. And it goes out on all their different markets at the same time. So next year we expect this to be quite good revenue increase for the textile impregnation segment for us. If we look at operations, which is a very important part for us in terms of cost and in terms of efficiency, we have invested in and implemented a new line for producing our bio-based binders. We thought that this would be able to produce 10,000 tons of binder per year, but now after having been running it for 3 months, we see that it is a 50% increase compared with what we thought. So it will be able to produce 15,000 tons. For Duni, just to give you an example, that is around 3,000 tons per year. So it can produce about five Dunis in this production line that we just invested in. So we are running this now on 1.5 shift, I would say, for the current, but you can run it up to five shifts. So this is a very efficient way. It's one operator that is running it per shift, so it's very low cost for producing binders with this production line. It's very automated. We also invested in a new water treatment system, which was implemented in September. That also reduces cost because we can recycle the process water that we have internally. Previously, we had to discard it through different firms so it had to be shipped away, and then we had to pay for that. Now we can recycle it and get it back into our production, so we can use the same water again. And this also reduces cost in our production. And one important thing, we have had our own internal biocomposite production for. We work with different biocomposites. We've been producing this material internally in the past, but now we have found out-licensing partners, which will reduce our cost extremely a lot, and we go over to more to a licensing and royalty-based model. So we will create the royalties from producing the biocomposites that we've done internally in the past, and this will substantially reduce our cost. Looking at the financial development during the last 5 years, we have been steady growing the revenues. during the last 5 years. However, we were affected quite a lot by the pandemic in terms of increasing raw material cost. And this you can see on the gross margin. They went down quite a lot in 2021, which at that stage when we also invested a lot in our own operations. We had a lot of investments for sales growth and also for building up our production. And that, in combination with the decline in gross margins was not good for our profit development. However, I have two lines here. One is the gross margin from variable cost, and one is the gross margin for including all the fixed cost. And these two lines we expect now when we increase the volumes of binders to start merging together. This is the scalability of our business model, which we see. Because next year, when we know that we have a much higher volume of binders, we don't expect any increase in OpEx. We have done all the investments needed in order to scale up our production and supply right now. And that will create a quite rapid increase in the gross margin, including the fixed production cost, moving up towards the gross margin for just variable cost. So what we see for next year is that we can keep the OpEx, maybe even have it a little bit lower than this year, due to the fact that we are doing much more automated production right now, while increasing revenues quite a lot. And just reminding you, what we have now for next year is the Duni deal, which will be in full force next year, so it will be more than 30 million in revenue, only from this deal. We believe we also will have further sales growth to Ahlstrom, as well as the new non-woven customers, which probably come in during middle of next year, I would say. And Organotex with the Snickers deal and also further revenue growth from going into new markets. But one of the most important thing right now in order to increase profitability is that we now have a budget of completely fixed OpEx next year. No increase on any part of in our operations. And that in combination with, of course, the increased revenues from binders and also from Organotex, we expect to have quite quick increase in profitability for us. So with that, I thank you for listening.
Thank you very much, Morten, for the presentation. So I have a question, and that is, what is the biggest focus area for you the coming year?
Well, binders. No, the binder business is certainly so as, for one aspect, the Duni agreement. We will focus a lot on supplying them, have a good full year supply, and make this more efficient and improve that in every way. Of course, this deal have also opened up a lot of other interest from a lot of customers who are now working hard to launch products as well. So really work together with our other partners to make them also transform away from the plastic binders to our binders is a very big focus for us.
Time is unfortunately running out, but thank you very much for your presentation.
Thank you.
Hi and welcome to ABG Sundal Collier's Investor Days. My name is Hanna Forsgren and I work as an equity research analyst here at ABG. With me today I have Per Eriksson, CEO, and Marcus, CFO. And Arise, welcome.
Thank you very much. I will start with a brief introduction of the company. Arise as a company was founded in 2007, listed on Nasdaq in 2010. We are still a quite small company, 39, actually we are 40 people, I think today. We have 3 business segments. One is production, which is the starting point for Arise as an IPP, 139 megawatts own production, annual production roughly around 340 gigawatt hours. Second leg in the business segments is our development business. Today we have a pipeline of around 2,600 megawatts, mainly wind, Sweden, but also solar, and also in some other countries as well, which we'll come back to. We have, since the beginning, divested some 1.3 gigawatt or 1,300 megawatts until today. We also have a third business segment, which is solutions, our services business, you could say. We have around 1,800 megawatts under management right now. We have under construction some 800 megawatts, which is a record level for us as we speak. Going a bit deeper into the business segments, we start with the production. As said, this is the starting point for Arise. We started up as an IPP, basically in southern Sweden, SC4, SC3, 139 megawatts. We have the development business. I can mention that here we have all the key competences we have in-house. For instance, permitting, planning, layout, grid, all the key competences we use internal resources. We have the solutions part, which is the asset management, which includes both technical management. We take care of, basically we provide a complete owner's function to the investors. Obviously we also handle our own assets as well, but we take care of the technical management, which means that we have manage all the contracts connected to the wind farms or the solar PVs, and also we have the financial management and also commercial management. So we do all the bookkeeping and all the we do board meetings, basically a complete owner's function. And concerning the construction management, we do project management. We have a project manager to manage the project, and also we have all the technical experts for different disciplines, like for turbines, like for internal grid, etc. So we have, even though we are small, we are quite complete in terms of having the key resources. Looking at our development as a company, you can see in the staples, which represents our own assets until today. You can also see here that between 13 and 18 we had another 100 megawatts, which was our 50% stake in Jädraås, which we divested in 2018-19. And you can see on the green line that is the investments we did until now. So 1.3 gigawatt. We started up the development business in 2013 and has been progressing that quite well until now. What we have developed represents a quite big value. We are talking about 1.5 billion euros in total investments for all our wind farms that we have developed until now, which we are quite proud about. With that, I leave the word to Marcus.
Yeah, thanks. So just an overview of the current project pipeline. Per-Erik mentioned it's about 2.6 gigawatts at the moment. We have around 300 megawatts in late-stage projects. Early-stage projects amount to about 2.3 gigawatts. And this will be a very important area for growth for Arise from now on. To kind of to develop this and to grow the pipeline, which we're quite confident in as well. Not least since it's sort of underpinned by a very strong financial position at the moment. At the end of Q3, we actually had a net cash position of almost 400 million SEK. So I think we're well capitalized to be able to continue growing the project pipeline. Just a recap of the Q3 report. Q3 was a record quarter for the company, explained by the sale of Kölvallen, which was completed in July this year. So net sales amounted to more than 900 million SEK, EBITDA more than 700 million SEK, and EBIT almost 700 million SEK. All of that due to the transaction for Kölvallen, which also impacted the cash flow, obviously. So we had really strong operating cash flow for the quarter, almost 800 million SEK, and cash flow after investments of 659. So all in all, a very strong quarter driven by the Kölvallen sale. We saw some headwind in our own production with very low wind speeds. We'll come back to a little bit more about that in the next slide. But production generated 52 gigawatt hours, which is low for the quarter. The average income was just below 500 SEK per megawatt hour, which was well below the market average. Again, we'll get back to that in the next slide. As mentioned, Kölvallen, in total, we saw upfront earnings impact of approximately 65 million euros. Shallow dive into the segments. Again, might be repeating myself, but the development segment, obviously very strong performance in the quarter with EBITDA of more than 700 million SEK. Kölvallen again. Our production, despite what I just mentioned about low wind speeds and quite challenging conditions, still decent EBITDA numbers of 12 million SEK, and our solutions business reasonably healthy EBITDA of 2 million SEK for the quarter. So looking into the prices on the left-hand side, you can see that Q3 2022 was an extreme quarter in terms of market prices, which on average were over 2,000 SEK per megawatt hour. For us as a producer, we suffer a bit from the extreme high price volatility, not only between days, but also between hours. Adding to that we have hedging positions which are well below those 2,000. I think for Q3 they were like 80 euros or 80 euros plus. Our realized price for the quarter was then well below market average. When we have these extremely low wind speeds and low production for the quarter, to some extent the hedging positions also can give some negative impact. But that's in the kind of extreme case, which you can see in the top right hand side, that the quarter we could have stretched or expanded this chart way back to the inception of Arise. I think 52 megawatt hours or gigawatt hours is unseen before. So it was a very extreme quarter. Another takeaway from the top right hand side is also that, you know, if there was one quarter which was extremely weak, then I prefer it to be the Q3 rather than the Q4 and Q1, which normally are the quarters that kind of are the strongest over the years. Hedging positions, bottom right-hand side, that is Q3 is unchanged from Q2. We did not take any further positions, partly due to the high volatility, partly also due to low liquidity in that market. But that's something that we're continuously evaluating and monitoring if we deem it attractive to add something into Q3 and Q4. Then I'll hand back to you, Fredrik.
Okay, thank you. Yeah, we had a few activities during 22. First, we did the green financing framework, 50 million euro bond that we completed in May, sorry. We also had an investment decision to construct Lebo project, 30 megawatts, which we will build in own book. We will finance it by ourselves, and then we will we have the flexibility if we want to keep it or if we want to divest it later on. So that flexibility is something that comes with a strong financial position. And the big event, of course, this year was the quite successful sale of Kölvallen, close 277 megawatts that we completed the 15th of July. One thing also that we think is good is that we have the possibility to keep a stake in Kölvallen, a 9% stake, which represents some 90 gigawatt hours to add to our production portfolio. We already started up preparations for our next project called Fasikan, some 100 megawatts up in SC2. We are awaiting to have the grid concession in legal force, where we have an appeal on the grid concession, but we expect to have that in legal force, let's say late Q3, early Q2 next year, late Q1 or early Q2 next year. And we are continuing, as we have a quite good position now, we are continued, or we have a focus to secure, of course, the product pipeline we have, but also we are looking into to increase the pipeline according to our strategy in selected geographies. That's underway. And a bit forward looking, we have a quite ambitious plan for growth. It's important to say that it should be a profitable growth. We are not a startup anymore. We have been in the market for more than 10 years. We have now a financial position, meaning that we can accelerate portfolio expansion. We have decided on selected markets at the moment, Nordics, UK and Poland. We have also taken the first step regarding organizational growth. And we have also already some results, first results on solar PV. We have some 50 megawatt in the portfolio now, and we plan to build the first 2 projects already next year, if everything goes as we hope. And regarding owning assets, we continue to have a quite dynamic approach to realizing value from our production portfolio, and we have the flexibility to divest or to keep it, and we have a much bigger flexibility compared to the situation we had just a few years ago. And we also see that the production creates quite good cash flows at the moment. Regarding M&A, we continuously evaluating M&A opportunities. Normally that could be project portfolios in different stages, both in solar PVs, but also in wind projects in different markets, in our different selected core markets, you could say. So that's it, I think. Yes, 50 minutes.
We made it.
Thank you very much, Per-Erik and Marcus. So then it's time for some Q&A. And my first question is, what is the biggest focus area for you the coming year?
I would say that is to increase the production portfolio. That's a key focus area for us.
All right.
And of course, to realize the projects we have, late stage projects as well. So those 2, I would say.
Long term, do you expect any geographies to be more or less interesting?
Yeah, that will vary over time, I'm sure about that. And we have a bit of a special political situation right now. For instance, you can see that there was a decision in EU in September, I think, to introduce price cap on power production, and that will lead to some different political initiatives in the short run, and it will be, I believe it will be different approaches in different countries, which might increase risk in some countries, depending on how the government handle that. But in the long run, I think it will vary between different countries and depending on which government that is in force.
All right. In 5 years, how do you think the portfolio will be divided?
I believe it will be divided in terms of geographies. That's clear, and we have a quite ambitious target how to grow the portfolio. So we will see much more diversified in geographies, but also in technologies. So we have quite strong ambitions to increase the solar PV part in our portfolio.
How are you affected by the current macro situation?
The market situation, you mean?
A macro situation.
The macro, yeah, okay. Yeah, we had a quite dramatic development in the market. I would say the last perhaps 2 or 3 years, but it was really exploded with an extreme price increase in general with the super inflation we had. So that has really impacted us. Capex has went up quite much. Steel prices been exploding. Components, electronics is there are difficulties in the supply chain. We had a COVID situation, supply chain issues, and then we had a hyperinflation for a number of years as well. On the other hand, we also had I have been in this for 34 years now and never seen anything close to the markets we have as well. So on the other hand, the increased market prices also increased the values. So it has been really, all the numbers has changed a lot during the last year. Much higher capex and much higher valuations as well.
Exactly. So far they have been kind of attached and hand in hand. With high inflation, higher capex, but that is partly also driven by the high electricity prices that we see. So the investor appetite is kind of still the same, even though the magnitude of the numbers have changed throughout, but so has the developer profit, at least what we have seen most recently.
I would say that the demand for the there's still a lot of capital in the market, and the demand for products is bigger than the access to good products in the market in general.
That was all questions for me. Thank you very much.
Yep. Thank you.
Good afternoon and welcome back to ABG Sundal Collier's Investor Days. My name is Benjamin Wallstedt. I am an equity research analyst covering the retail sector working from the Stockholm office. With me today to present Fiskars Group is company CEO Jussi Siitonen. So Jussi, the floor is yours.
Thank you, Benjamin, and hello everyone. Greetings from Helsinki. So in the next 20 minutes, I will walk you through what is Fiskars all about, focusing very much on our growth strategy we initiated a year ago in November, then going through also how we see the near future here, and then it's all about Q&A after that one. If we move to the next page, please. So Fiskars is all about strong brand portfolio. We call is a global home of design-driven brands for indoor and then for outdoor living. We have one brand which is very much for outdoor. The company was established already 1648. 48. So we are almost 375 years old. In 2 years' time, we have our 375th anniversary. We are very much focusing on premium brands. The new strategy is highlighting the must-win brands what we have in our portfolio, the countries where we believe that we can continue growing faster organically. So I would like to highlight that this is a company for organic growth. We have more than 350 own stores, so we are very much focusing on direct consumer, both retail and e-commerce. They are already now roughly 20% of our business, and we see that those are the ones which are providing most of the growth in the near future. Moving to the next page, it's pretty much our brand portfolio. And you can see quite well-known brands there. Of course, Fiskars as a brand is the biggest part of the company, a bit less than 40%. And then the luxury brands like Royal Copenhagen, Wedgwood, Waterford are part of our portfolio. Then brands with some better known in Nordic, like Iittala, Arabia, Hackman, and Rörstrand are also part of our portfolio. As you can see, we have plenty of the brands. However, we have identified a handful of brands which are the must-win brands, and I will walk them through a bit later. On the next page, you can see how the business is structured. So we have three main categories, main business area here. We call them Vita, Terra, and Crea. Vita is very much focusing on tableware, drinkware, and interior. So that's what we have highlighted, that we are a high premium brand company, and you can see the brands what we have here, Royal Copenhagen, Wedgwood being number 1 and number 2 brands in China, in those categories where we are playing. Wedgwood is the brand in UK as a part of the Royal family there, as well as Royal Copenhagen is the brand here in Nordic. This is the biggest, fastest growing business what we have in our portfolio with a bit more than 40% share of total sales. Then two more categories, Terra and Crea, they are more functional businesses. Terra is very much focusing on gardening and outdoor products there. Also watering is included in the business, but it's a smaller share. And then Crea, which is very much scissors, creating and cooking. So those orange Fiskars scissors are our world-known products in our portfolio, and they are here in Crea category. Moving to the next page, and this is highlighting why we call us being a company in transformation. So when we started to set up a new strategy, we were very much focusing on growth, and the reason for that was that we had a long period of no growth there. Top line were quite stable. We were there on a low single-digit type of growth. Profitability was at okayish level. We were there double-digit EBIT at certain point, but then especially when we started to figure out that actually our cost base is not developing the way we like it, and our gross margins are not the level they should be for the branded good companies, we started to change the strategy. The management, the leadership of the company was changed. Our CEO, Natalie Ahlström, she started a couple of years ago. I started a year ago. My background is in consumer goods business in a company called Amesports there. And with the leadership team, we started to transform the company for more towards growth focused rather than just keeping the business a very stable way. What we identified is the company logic, where we are focusing, where we need to win. We identified transformation levers and then enablers, how we see we can deliver the targeted growth. If we go to the next page, please. You can see here the logic what we have. So we are focusing on winning brands. The winning brands are Royal Copenhagen, Fiskars, Moomin by Arabia, Gerber, and Iittala. As you can see, many of those brands are very Nordic focused. However, we see that they have a lot of potential also being a truly global brands. For example, Royal Copenhagen is the brand which is growing fastest now in China instead of Europe. So those brands are identified as must-win brands because the potential for organic growth globally is the most significant in those brands. Channels, as I already mentioned, direct consumer, both own retail and own e-commerce, they are only 20% of our sales. We believe that in the next couple of years, the company growth is mainly coming from those channels, own retail, own e-commerce. Whilst the wholesale, we see that that's steadily declining in the industry overall. And then the countries, we have identified 6 winning countries. USA being the biggest country for us. So USA is 1/3 of the whole company sales. Then China is the fastest growing country for the company. For example, year to date, September, we were over 30% growth, despite those lockdowns what we have seen, especially in Shanghai area. And then the 4 more established countries, Finland, Sweden, Denmark, are country 2, 3, and 4 in our portfolio. Both are there, give or take, roughly 100 million type of countries. We see that we still have a lot of potential growing in those countries, despite that we already have a quite good footprint in those countries. And then Germany, in Central Europe, especially in gardening, we have identified a country where we have a lot of opportunities. Then the transformation levers, I already tackled the direct-to-consumer, US and China there. One extremely important for us is commercial excellence. And it might sound a bit trivial type of topics here, but bearing in mind where the company is coming from, we see that we still have a lot of untapped potential there when it comes to in-store excellence, when it comes to channel right assortment, when it comes to good, better, best pricing, being more selective with our distribution, and bearing in mind that we are the branded food company, we can price out our product much better way than we have done in the past. Of course, the existing business environment is not very much supportive for this one, but still we have succeeded to increase prices, even though there has been a certain supply chain challenges in these businesses. So these are the ones where we believe are transforming the company. I would like to highlight one enabler what we have here, and that's digital. So we have invested quite significantly in digital when it comes to advanced analytics, when it comes to digital capabilities there in marketing. And those are the ones which are not only supporting our own e-commerce or retail or D2C overall, but they are also supporting our wholesale customers there, what we can offer, where we see that there's a now demand in our own channels, and then can provide that information also to our wholesale partners. So digital is the one where we have invested mostly in the past quarters. Moving then to slide number 9, which is part of our strategy. Still one, please. Yeah. One slide. Yeah, this still, if you go to the financial KPIs, this one, thank you. So together with the strategy, we updated also our financial targets. So that instead of having a quite general type of targets, we try to be very specific. So that on net sales, the current target is to grow organically, mid-single digit year after year. So we are targeting roughly 5% growth there. Last year, in 2021, we overperformed this target quite nicely with 14% growth. And still, in the last 12 months, a rolling basis, end of September, we were over 5% growth at 8% level. On EBIT, the target what we have set for the company is to deliver roughly 15% EBIT by end of 2025, so that it's not a hockey stick, all the improvements coming on very late in this period. But we have said that improvement should come steadily there year after year. That would mean roughly 50 basis point improvement until 2025. You can see that we improved profitability quite nicely in 2021, 250 basis point from previous years. This year, on last 12-month basis, we are coming up slightly down, mainly due to this inflationary impact what we have seen there in our raw materials, and we haven't yet been fully able to price it out. The actions have been in place. We have seen already quite, let's say, positive impact there, especially in Q3. We got gross margins up versus last year, but of course, when we take rolling 12 months, we are not yet benefiting fully on those efforts. Then the one thing which has been mainly consumer goods type of companies challenge this year is the cash flow. Our cash flow, free cash flow for the first 9 months, and if we take last 12 months rolling, has been negative due to the fact that inventory levels has peaked out. That's especially the case in USA, but we have also seen that happening in Europe. In the past, you can see that the target what we have set for the company, free cash flow net profit ratio, we have been well above that one. This year, already now we can say that we are not meeting the targets. The good thing, however, is that the company has very strong balance sheet. So our net debt EBITDA target of being max 2.5x, we have been well below that one in the past few years, so that in early this year, we were almost net debt negative there. Now we have funded our organic business, mainly working capital here, and therefore you can see that now we are at level of 1.8x. We are pretty confident in the financial targets we have set the company. Mostly, we have been challenged by our EBIT targets, how we can improve profitability from current roughly 12% level all the way up to 15% in next couple of years. The arguments are very much focusing then on commercial excellence. We see that we have potential there for gross margin improvement. And that's actually something I can demonstrate more if you go back on page number 5, where we are saying that we are transforming the profile of the company. If possibility to move back to that slide, slide number 5. Thank you, this one. So here you can see the gross margin curve in the middle. So currently we are there at 44.6%. We see that our P&L structure, bearing in mind how much we can continue growing in own retail, which of course is very high price point product for us in terms of gross margin, we believe that our right P&L structure would be so that gross margins are there at level of 48-49%. Then operating expenses, they're at level of 33 something, where we are actually at the moment. So you can see that the strategy is built on a gross margin improvement rather than continuous cost cutting. And we consider that being a way to sustainably run the business so that we are running it through gross margins rather than making this kind of cost cutting every now and then, because those are not the ones which are feeding the organic growth that we have for the company. Then moving more on daily topics, and if you go please to slide number 16, where we are talking about our short-term, thank you, this one. So what we have said is that when it comes to our own investments, which are totally in our own hands, we are talking investment in digital, we are talking investments in D2C. We continue with those investments. That's the plan. Then the strategic focus area and transformation levers, they are delivering results. If they are not yet fully visible in the numbers, for example, commercial excellence there on gross margins, we can see that on long term, they are delivering the results. And now, even if we take past couple of months, we see that the price increases we have implemented, the new joint business plan we have put together with our big customers, they are delivering the results. We had a good period of 9 consecutive growth quarter in a row. Q3 this year was flat. And we see that this kind of challenging environmental things like continuous inflation, like supply chain challenges, that will continue. We have split the world into 3 different parts. So when we are now planning for next year and for the coming quarters, we believe that in USA, the first half next year will be very challenging. Then the second half, we believe that we start seeing some positive turn so that even growth can be reignited in USA for the second half 2023. When it comes to Asia, especially in China, we have seen the current trend continuing, and the building blocks what we have behind for that growth, especially relating to Royal Copenhagen brand, Westwood brand, how we can continue growing there with our own retail, gives us confidence to continue delivering strong double-digit growth also next year in China. As said, for the first 9 months this year, we are over 30% growth with our China business. It's quite small. We are talking about business which is roughly 4% of the company sales. It's all about Vita business. And then last but not least, Europe. In Europe, especially here in Nordic, we see no improvement whatsoever for 2023. So we are planning against very flat top line. We are planning against continuous inflationary impacts here. And still we believe that we have potential also in our home markets here in Denmark, Sweden, and Finland. That's very briefly my short opening here, and now I'm ready for Q&A.
Perfect. Thank you very much, Jussi, for that presentation. So Fiskars obviously has a very long history. You mentioned a 350-year anniversary coming up. Over that time period, what have you learned about consumer behavior in tougher times?
Yeah, if we consider tougher times, for example, 2020 COVID period here, we admittedly got some tailwinds from that market, because then everything relating to home, relating to this environment where you were able to live in COVID times, you wanted to invest in those. And we got some tailwinds there, especially when it comes to Vita business, home glassware, tableware, home decorations and the likes, as well as when it comes to your backyard, gardening and the likes. So we got some tailwinds there. The good thing is that now we have demonstrated that we can continue growing also in post-COVID time. And then when it comes to this kind of things that consumer sentiment is a bit gloomy, and inflationary impacts are there. What we have seen in the past is typically, even though we are talking about luxury product, premium product in our portfolio, we are anyhow not talking about this kind of high price point product. We are not talking about cars. We are not talking about that kind of things. So we still see consumer buying these kind of products. In gloomy times, you want to build something nice around you, and our products are very good in that one. When I've been talking with my colleagues, having been longer in this industry and this company, they have said that typically this kind of recessionary type of times, we haven't suffered so much there because we are not in that kind of high price point product.
Perfect. Thank you very much. You also hinted that there is a working capital build-up, and I believe that is true for your customers, the retailers as well. How do you think about the high retailer inventory levels going into 2023, please?
This is a very interesting topic, and as I said, when we split world to the 3 parts, that was very much wholesale. The good thing is that even at the moment when the retailers' inventory levels are picking up, and now I'm talking about big boxes, especially in US, Home Depot, Amazon, Walmart type of things, the Targets, which are all our customers. There we see that retailers, they are running their business now against cash flow. So they are trying to get rid of inventories. We are expecting also quite high promotional period there early next year when they are trying to get the inventories melting down. The good thing is that the end consumer, and we have pretty good grip on end consumer there due to the fact that we have quite wide own retail network. The end consumer is alive and buying, and that helps us also to navigate through this one. So it's this middle layer now who are suffering and running business against cash flow.
Perfect. And coming back to that middle layer, as you call them, obviously one of your strategic pillars is moving more towards direct sales. How do you avoid getting pushback from retailers when you sort of steal their market, so to speak?
That's, as I said, it's only 20% of our current sales at the moment. So 80% is still coming from other businesses. This 20% is mainly in our Vita, which means that in Vita business, it's much more. We are talking about more than 1/3, even 40% of their business coming from D2C. Still, in more functional categories, big boxes are the ones which are selling our gardening products, our outdoor products and the likes. We are in pretty good I would say we are in very good collaborations with our retailers at the moment due to the fact that all what we have done with our commercial excellence, channel right assortment there, that only the certain products are available in our stores. We make sure that customer profile, customer selection is valid so that we are not jeopardizing their business with our offering. And always the same product what we are selling there are not typically cheaper in our stores. So it's all the other arguments there. In-store excellence, what else we can offer on top of that? Do we have models which are only available in our D2C? And this kind of channel right assortment approach is the one which has made it quite easy to live with our retail customers at the same time when we continue increasing our own D2C.
Perfect. Another trend that I hear about when I talk to you and other customers, brand owners tend to be more careful about who they distribute their products to nowadays. There are brand risks from discounting, for example. How does Fiskars think about that issue?
Yeah, we are especially in that same trend. We are getting more and more carefully with our retail customers there, what they can sell, what's the product structure there. The good thing is that we have quite wide brand portfolio. So we can also use our tactical brands in certain channels. And of course, then they can go to the lower price point. But what is very important for us is that the brands which are available in our own D2C, our retail customers can't go to the same categories with the only strategy of being at discount mode. That's what we need to be very careful. We are ready to clean the pipeline, clean our customer base, so that terms and concept and joint business plans, what we have in place with our retail customers, are valid and they are supporting our brands.
Perfect. Thank you very much. With that, I believe it is now time to wrap up. So I would like to thank you, Jussi, for participating today, and you guys for attending. Thank you very much.
Thank you.
Hi everyone, and welcome to ABG Investor Days. My name is Nikola Kalanowski, and I'm an equity research analyst here at ABG. With us today we have Nilörn Gruppen's CEO, Christer Magnusson. Christer will give us a presentation for about 20 minutes, and then we will proceed with a brief Q&A. And with that said, Christer, the floor is yours.
Thank you very much. I'm sitting here in the office in Borås, the head office. Unfortunately, I couldn't manage to go to Stockholm today, so I hope it will doing that through the Teams. I will, with my presentation, my wish is to give you a feeling of the journey where Nilörn are today and where we're heading to. So I will give you a little bit historical background, the changes we are doing and why, and what is Nilörn unique, and a little bit about our competitors, and so you have a better picture of Nilörn and the future where we are going to. Next. Our vision is to be the best label and branding company worldwide. It has been there for some time. What does that mean? It doesn't mean to be the biggest, but we want to be best in our niche. And when our niche are and so on, I will come back to that a little bit later in the presentation, so you will have an understanding. And also the aim that is with this presentation is where we are when we are the best company. Our slogan, adding value to your brand, has also been for very many years. And I think it's very good because it's clearly say what we are doing, even though the underlying what we do is a little bit different now versus in the past. We are actually, we're adding value to our clients, their brands, and even though it's changed maybe to more to sustainability and so on, we're still adding value. So it's still going strong. Next. The historical overview. We started here in Borås, the head office, and we have built up the company. And during 1990s was a lot of expansion, and the company went to the Stockholm Stock Exchange in 98 to get raising more funds for the expansion out in Europe. Company bought a lot of production units around in Europe, in Germany, Belgium, UK, Portugal, Denmark, and Sweden. And of course, what happens then was that so we produced the labels in Europe and shipped them to Asia because all the garments manufacturers were situated in Asia. And then, of course, competition from Asia became too intense. So in the beginning of 2000 and to like 2010, between there, it took a lot of cost closing down the production in Europe. And those units has become our sales operations in Europe now. So in 2010, we changed the focus to be much more client-driven, more sales-driven. And we changed to MD at that time. And the company was delisted in 2009, and with Traction as a major shareholder. So we became a much more client-driven, much more sales-focused, and we opened up sourcing and distribution offices around in Asia, as it mentioned here on the slide, like in Bangladesh, India, Pakistan, Shanghai, and Turkey. And we also started off with sales conferences and build a culture within the group. And I think that is also one thing that is really unique with the Nilörn. We are quite an international company with subsidiaries in 15 countries, but we are like a family. We are only 580 employees. Not saying that you know everyone by name, but we have got a really good culture within the group, which is quite unique. And also the goal is not to be a production company, still to be very client focused and smooth towards the client. And by not owning so much own production, we can also follow our client around in the world where they are producing. The trend we see now is clients moving back to Europe mainly from China. And if we were to get stuck a lot of own production in China, that would cost a lot of money. We still have some production. I'm coming back to that a little bit later. Next. I used to say that when we had our own production, that was Nilon 1.0, then we were very much decentralized with sales operations all around in Europe, and also established our sourcing operations, Nilon 2.0. And then we were hit here by the COVID, as you can see, and in 2019 was a bit slow, then 2018, and then the COVID 2020. And the trend we also seen, where you have the arrow, is very much focusing on the sustainability, the CSR. We employed a sustainability manager 6 years ago. That was the first movement in the CSR area. And the client we have is mainly brand owners, and quite many in the sports sector, which are very much focused on the CSR. And that will also be more of that in the presentation I have to you today. And so we have done quite big changes within the group in terms of the CSR and to have skills within that area. Next. So what have we done? Yeah, in starting here from the beginning to 2020, we've done a lot of structural changes. We have done setting up a sourcing operation. We have employed a sourcing manager. That's something we didn't have in the past. We set up more people, both in CSR, both in Europe, but around in Asia, in different countries. Sustainability manager I mentioned. And we got persons in compliance, now employed persons working in compliance. Why should we have a compliance person within Nilon? I mean, all this is client-driven, and people, especially in packaging and so on, which is an area we are focusing as well. There are a lot of focusing on compliance that we are helping out our client now. Material, also sustainable-driven, finding out new material, less impact on the environment. Packaging is an area that we have tried quite a long time ago, but not really succeeded in that. We're doing that differently now. Instead of just employing one person doing everything, we are taking a bigger grip on that. So we have set up a team about packaging, and that fits also quite well with the e-commerce trend and also in the sustainable area, because we are helping out our client in this area as well. We are doing also a lot of focusing on systems. To be able to be good within CSR, and we need to know what material and so on we are producing the different articles in. We also need to know and follow up our suppliers. We need to know the key performance indicators and so on. So that is something we also spent quite a lot of resources lately, and that we will continue to invest in that as well. Activity plan is that we are working much more structured in sales. In the past, each sales company invented the wheel themselves and very, very decentralized. Now we try to help the sales companies. We give them a toolbox how to perform, and there will be more acting as advisor and not less the traditional sales. RFID, yeah, is coming. And that means that we have built up the organization. We've done quite some investments, and we set up new offices as well here in Spain and in Italy. And we're more structured in terms of marketing, and we have won new clients. That is what we have done. Next. And the aim is to reach with all this structured work, and we're doing here is to go to Nilon 3.0, and we try to be a little bit more structured in the way we're operating, a little bit more centralized, but still to have the innovative and flexibility towards the client. So we try to catch the best of the both worlds. We're working on being very transparent and creative, fast, modern, and reliable. All this, the client should feel this when we are ready with this, the 3.0. So we're working hard on this, and fast and modern and reliable. Reliable is a word which we are working within the group now. So people should feel that Nilon as a supplier is a reliable supplier. Next. Next. Yes, unique selling points. In the past, it was always design that was unique selling points. It's still very, very important for us. It's still one of the unique selling points, but it's now even more into the sustainable area. We see, and that is also client-driven. This is what they want, and this is what they need the help of. And that is also technical. Goes also hand in hand. We're building up system now, providing information to our client through our web order system. Instead of them asking for information, we will provide them with the information to make it easy for them. And I think, and I'm quite sure that if we manage to do this, this will be a good competitive advantage for Nilörn. Relatively, especially relatively our smaller competitors that don't have the resources. Next. And here is the rest of the unique selling points. Responsive, we need to be quick. Our distribution around in Asia, we are looking to some more countries now. Our web order system I mentioned, and the unique staff. And I think that we have managed really good in getting these teamwork in the group. Not too big, not like a super big company, but still have this consistency in quality, and that is still very, very important. Next. Our sustainable journey. This we started in 2019 when we made our first sustainability report, and this is areas that we as a group focusing on the client, product and supply chain and employees and all the areas around that. So we're doing a work now for 2023 and the sustainable report that will be even more. Next. Product description. This is where we are coming from. This is our traditional with the labels and all sorts of labels from woven, textile, hangtext, etc. This is core Nilörn, you can say. Next. And we're now heading into packaging and accessories. That was I mentioned earlier. The packaging, I mean, it's probably not so much brown plain boxes we're doing. It's more, as you can see on the picture here, more design boxes where you have shirts and so on. We're also doing quite a lot of recycled poly bags in the sustainable material. Next. Another area that we see is coming more and more is the RFID, and coming back to that a bit more in the next slide. But here on the left-hand side, you can see what we supply. This is the label, and including an antenna and a chip, which is readable. We don't provide the hardware and we don't provide the software. There are other suppliers doing that, but we supply the labels and we program the labels. Next. And why is RFID essential? It's more than just it is pre-sales for the whole logistics chains for the client to have control of their logistics change. And within RFID and also within packaging is slightly lower margin but bigger volumes. A box costing much more money than just a small label. Next. Here is also now we have developed, it's a Nilörn Connect. We see a trend here also within the sustainable area that when you as a client buy a garment and then you receive it home and then you can read the QR code and then you can read about the garment, where that is produced, and the information that you will see on this in your mobile phone in this example, it's up to the client where they want to, and they can also change this information during the way. So, and they can also show it to the garment owner here in what factory the garment has been produced, what it contains, and the carbon footprint and so on. And this can be either through QR codes or NFC chip. So it's different techniques for that. Yeah, next. It's a little bit slide about competitors and the different competitors we have. We Avery Dennison is the biggest in the world. We are in slightly different customers. They are focusing on the really big one like H&M and so on. We, as Nilon, we are the step below with more brand owners. And I think also in this climate, it can be an advantage if you see that retailers, they are the one suffer quite much in the current climate. But Nilon is focusing very much on the brand owners. So I think that is also good going forward to know. Trimco Group has bought Atex, that used to be our, or still is, one of our major competitors. It's a Danish company. They were bought by a Swiss company and then a Chinese group, Trimco, and then just recently sold, what I read here, to an American company, Brookfields. So they consist of 3 companies, Clotex, Labelon, and Atex, this group. And they are then sold here, what I heard. Yeah, I will not go through all this. CCL bought Checkpoint. Both CCL is Canadian, Checkpoint is US. Cadica Italian. Yeah, Rudolf and Haag is our Swedish friends here in Borås. Manetti Italian. Yeah. Here, I didn't know if I should add this slide or not. This is just for, but I thought it would be good to give you a view on the x-axis. You have production and logistic. If Nilon, we don't have so much own production. It's like 15% what we produce is own produced. And logistic area, there are countries that we're not into. We are looking to establish now own office in Vietnam. We are operating through our partners so far in Vietnam, but we are in quite well in Asia. We are also looking for Central America here as well. That can be, but we think, and then on the y-axis, you have the value added for product and services. And here, what we are aiming for now is moving further up on this axis. So we will we see the future here coming more and more up northeast, you would say, to be even more giving more service to our clients in terms. And I think the trend we also see, I mean, in the past we were selling labels. It's more and more coming into it, giving advice and supporting our clients, and all with this in the sustainable and in compliance and the regulations, and helping them providing information to their end users and so on. So we are more a service provider. So yeah, we're moving up north directions. And the other should symbolize, the competitors next. Yeah, core values. We used to have 7. We decreased this to 3. I want all the employees within the group knowing what we should stand for. Innovations. We want to be in the forefront, be seen as an innovative companies, finding new way of doing, and be innovative and be in the forefront. Respect. We are in 15 different countries, a lot of different religions, culture, and so on. So the respect is crucial. And responsible to take action. The employees within the group should take action and be responsible for what they're doing. So this is the part of the culture, and we are building. Next. I will not go through this in detail. You've seen this probably in the past, that Q2 and Q4 are the main important quarters. And next. And here it is similar, the historical for the result. Next. Here is about the key financial indicators. We are up to 579 employees, quite many of them in production and logistic, but we also increased number of employees now supporting organization in sourcing and the different areas. We are, as you can see, an operating margin now per end of September accumulated 16.4. Historically, we've been before 2021, we're around 10 to 12%. You can say the last 12 years. and now the last year we outperformed quite well. Will we continue to do such a good performance, or will it go down? I think it will be tough to be on this high level going long forward. Next. And yeah, then just a very short summary here. You can see the turnover, and if you're looking at the 12 months rolling numbers, we're very close to the 1 billion goal we have. The best year we ever did before pandemic was 2019 with 780 million, and the operating profit was 162 million, where we pre-pandemic made an operating profit of 85, which was the best year ever then. So we almost doubled the best year ever before the pandemic. Not really, but almost, yeah. I've gone through these new countries. We see, I mean, we've been growing a lot in first we've been also big in the Nordic countries. We've grown quite a lot in UK, and then last year much in Germany, but now we see trend towards Italy, France, and Spain, and also now starting in US. Next. Yeah, next again. Yeah, the financial targets set by the board. We should have annual growth of excess 7% and operating margin of at least 10 to 12%. Yeah, and I think looking at the historical number, we outperformed that quite well. But that is a good target set by the board. Yeah. Next. Yeah, we're doing everything here. I mean, I think we need a satisfied client, customers. That is the goal, and if we do get that, we will also get the profitability with us. And we are working hard to make Nilörn attractive and as an investment for you all. Thank you. That's it for now.
All right. Thank you very much for the presentation, Christer. I thought that we can follow up with just a brief Q&A and then finish off this presentation. So my first question would be, given that the retail sector has been one of the first sectors to face the consequences of inflation, and also given that operationally you've done very well thus far, what kind of behavior are you seeing in the retail space, and what is your outlook for 2023?
Yeah, and I think as you're right on it with the retail sector. I think many retailers at the moment they are sitting with quite much stock, but I also think what the beauty with Nilörn is that we have, as I mentioned earlier, that we have retailers, but we also have quite many of our clients is brand owners, and they are I don't think they are affected that much as the retailers. And how will that? But of course we will be affected in the future, and I think for 2023 it's a quite big uncertainty in the market what happens, and I think that is the most crucial point. Also, if you take a parallel to the pandemic, I remember when I became the CEO in the spring 2020, there was such a big uncertainty in the market, and everyone was scared. And then there was quite a big bounce back. Not taking too much parallel to that, but I think the uncertainty is there at the moment. So we will see what happens.
Yeah, absolutely. I definitely think that we all are curious to see what will happen in 23, whether we will get a bounce back like in the pandemic or not. We will simply see.
And also, I mean, there's also, I mean, if now the retail is sitting with too much stock and they be too cautious again, and with the risk that they are ending out of no stock, it goes the bigger swings. I mean, from ups and downs at the moment, I think.
Absolutely. And so you sit on a net cash position now, and that gives you options in today's economy. What is your view on distributing cash to shareholders versus
I guess, investing in growth. What is your view on that?
Yeah, I mean, first of all, I mean, it's not my decision if we dividend and so on, it's the board, but I think it can open up opportunities for us now. We both in own expansion in our own factories, but also looking for acquisitions and so on. We are working on that. Not saying that we have something that will be announced today, but we are working on that, absolutely.
Excellent. Well, we have run out of time, but thank you very much, Christer, for presenting to us and taking this Q&A, and for the audience for listening. Thank you very much.
Fine. Thank you very much. Thank you. Bye.